and data that is really having trouble sending us a clear signal.
The adjustment we've seen in markets has been quite small, given the news that we have from Powell.
It's important that he laid out just how data dependent they are and the willingness to pivot.
The Fed talks too much. I have thought that throughout this whole cycle. There's too much talking, too much talk of disinflation.
If we are going to consider re-accelerating to 50 based on the data, and they are very data dependent, the risk of a hard landing does go up.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Chairman Powell, day 3. Can you imagine that? 3 days of that?
I actually
no,
think
thank
that
you.
no one
No,
wants
thank
that.
you. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance. Equity futures on the S&P. We're down about 0.2%. TK, it's all about the data now. Jobless claims a little bit later. Payrolls tomorrow.
You know, claims after the ADP report. I still don't know what to do with ADP. Full disclosure on that. The JOLT survey, clearly the zeitgeist says that's what we paid attention to yesterday. It sort of sustained where we are. But, John, I'm going to call it quiescent Thursday. We're into where we're waiting for claims and then jobs.
Just a little bit of daylight between day 1 of testimony on Capitol Hill for Chairman Powell and day 2. Some ifs and buts. At the top of the statement. Some ifs, some important ifs here, Lisa.
This is Jay Powell trying to wiggle himself out of committing to a 50 basis point rate hike. The funniest part about it was the market didn't buy it in any way, shape, or form. They actually increased the chances of a 50 basis point rate hike. This was Jay Powell trying to say, don't just move off the jobs report. There are other things, too. People are like, OK, we're just going to move off the jobs report. But basically, there is this feeling he's going to say one thing and markets are going to do something else.
But isn't JOLTS signifying a fully employed America?
JOLTS came in, headed in the right direction. They probably see that as improvement. The quits rate fell a little bit as well, but still way, way too elevated for this Federal Reserve. Jobless claims we're expecting something in and around 200K again. And tomorrow we're going to get payrolls, and the estimate so far is something in and around 200,000.
The problem is every single data point we're getting, there's something for everyone. You can confirm your narrative no matter what you look at. If you look at the JOLTS in particular, it's a perfect example of that. Headline number came in hotter than expected, bad for the Fed, but the quits rate came in lower than expected. It declined more than people expected, good for the Fed. You can choose your narrative, and the Fed basically says, we don't want to get involved, but they kind of have to, and that's the problem.
Should we squeeze in some Credit Suisse news?
I think we've got to look at the Credit Suisse
narrative. Can you find or remember a day when you got some good news for this bank? Credit Suisse has delayed the publication of its annual report and compensation details for 2022 after US regulators raised last-minute technical queries, Tom, on previous statements.
You know, I looked at a weekly log chart, and again, this is in Swiss francs, which proxies to the dollar pretty well. And basically, John, this is 10 on a moving average basis, maybe even $11, 11 Swiss francs per share, down to 2.5. I think that's a 75% decline since the beginning of last year. How long can they sustain it? And if this chart is there's no higher high or higher low evident.
Oh, it's ugly, and the hits keep coming. Yeah. That stock is down by almost 6% right now, 250. 250 on Credit Suisse.
Hold on, it's coming. I didn't pay the mouse today on the terminal, excuse me. Price to book, 0.16. 0.16.
Yeah, that's a problem.
You know, and I think we've got to listen to John Patrick when he's on today about the future here, like the future into April.
We'll catch up with the team over in Europe a little bit later this morning. Good morning to you. Let's whip through the price action together. Equity futures negative about 0.25% on the S&P. Lisa mentioned just this bond market shrugging off everything Chair Powell had to say yesterday. Yesterday, your 2-year yield higher for a third straight session. Today, we come back in just a little bit. We're down 4 basis points on a 2-year, 5.03% on a 10-year. Basically unchanged here, Lisa. Your 10-year, 398.55.
So it's not perhaps day 3 of Jay Powell, but it is day, whatever you want to call it, of data that we could potentially sift through and get some sense of the narrative that we want to confirm. We get challenger job cuts at 7:30 a.m. Do we see job cuts starting to increase as you start to see the quits rate decrease, signs of a tightening labor market, and then initial jobless claims that come out at 8:30 a.m. Do we still see incredibly low numbers? And then, of course, at noon, we get the fourth quarter household change in net worth. How do we really get a sense of a cohesion in the narrative if it is sort of a choose-your-own-adventure kind of picture that is backward-looking? 10 a.m. we hear from Fed Vice Chair for Supervision Michael Barr. He's talking about crypto. I'm sure we'll hear about Silvergate. We're going to be speaking about that later. And then later on in the afternoon in the United States time, but in Japan, into Friday, it is the last Bank of Japan meeting with Governor Kuroda at the helm. Not expecting necessarily a huge move, but to me, I think this could be really telling as we prepare for the Ueda era, especially given the fact that there are some pretty big bets accumulating about the yen and the direction it will follow. And today, President Biden will be releasing his budget proposal in Philadelphia. We'll be talking about tax increases. We'll be talking about some of the proposals that got cut in the proposal that he had last year. None of this is going to get passed. We're going to hear from Anne Marie. She's going to say it's all dead in the water, basically, things that are talking points. But what it does signal, perhaps, are the lines being drawn ahead of the debt ceiling debate, John. And I think that that's really where we could get some real information about how those negotiations will go forward.
That's not a budget, Tom. That's not a budget. That's a campaign speech.
It's a campaign speech.
A little bit later.
What's the 25% tax on billionaires? On their income?
Are you concerned
on their
about
wealth?
that?
Yeah, I'm worried. I was up all night worrying about it.
Well, we have discussed wealth taxes before. They're very, very difficult to implement.
In America, hugely
Massively
difficult.
so. Hugely.
I assume
they get a lot of support.
Too.
I should expect them to, because many people aren't billionaires and they see that as a good source of tax revenue. But ultimately, very, very difficult to execute.
From the 42 guys that are billionaires.
I think this closer. The actual number is closer to 700 to 800 in America. Yeah.
Really, I did not know
something like that, according to Forbes.
Okay, they all play in Major League Baseball.
We've done that. Did any billionaires in Major League Baseball?
I don't know. I mean, I assume Mr. Jordan in basketball is.
I'm sure they're making real money.
No one on the tots is.
Well, we'll talk about Spurs a little bit later.
Let's go.
We'll save that. Steve Chevron, Head of Multi-Asset Solutions and Senior Portfolio Manager at Federated Hermes. Steve, let's start with this equity market. Just why is this NASDAQ leading?
Well, hold on. Before we go there, I just want to say I wish I was a Major League Baseball player. That was the original plan. This was the backup. So, look, I think from a market perspective, what the bond market did this week was different. And I think that's why you saw the NASDAQ as resilient as it was. And that was, in prior hawkish episodes, you'd see both the 2-year and the 10-year sell off. They both would sell off. The 2-year would sell off a little bit more and the curve would invert some. In this case, the 2-year sold off, but the 10-year held serve. And I think what you're starting to see the bond market at least try to sniff out is this idea that this more resilient economy and this more persistent inflation today is in fact pushing the Fed to be more hawkish, a higher terminal rate, and that raises the risk to growth tomorrow. And in that environment where you are pricing a growth slowdown, you probably don't want to be quite as underweight growth as you would be in just this unending inflation environment. And I think that was a little bit of the sniff out. I wouldn't make too much of it, with a day or two, but that was my read.
See, the Federated Hermes has a timeline that's appropriate, 3 years, even 5 years out. Let's talk about that growthiness right now. You guys are acclaimed. And this really, folks, goes back to Pittsburgh in 73, 74. You're acclaimed of getting out front on gloom. When do you go growthy? What is the signal you need to see to climb back on growth?
So, Tom, I don't know if it's growth that we climb back on. And that's not because we're trying to be gloomy. When you look at the experience of the last couple of years and you think about what's been scarce or what's changed, right? You've seen supply chains be reconfigured. You've seen re-onshoring, 500 to 700,000 jobs per year now. And when you look at what's scarce in this economy, it's really not growth or technology. What's scarce is that which was old. Think about, we don't have enough infrastructure in this country, whether it's energy, whether it's materials. If you're going to be producing more in the United States, there's probably going to be a lot of demand for industrials. You're going to need financing for that from banks. So at this point, our bias is that once we are through whatever economic slowdown that's going to follow this kind of hike cycle, we think really the next set of leadership is going to be cyclicals, not growth. And if you think about it, it makes sense historically. You didn't have tech lead you out of 2000. You didn't have banks and real estate lead you out of 07, 08. And we don't think it's necessarily going to be growth that leads you out of this cycle. We think it's going to be the cyclicals. What's old will be new again. And that's where I expect we'll take our long-term kind of bullish bets. We're not there yet, but that's the direction we're eyeing.
That's within the equity portfolio. Just more broadly, how much more weighted are you to the fixed income side at the expense of your previous equity allocations?
Mm-hmm. So, we've been accused in the past of being perma-bulls, and we've been pretty conservative for the last, year plus. But we're not over our skis in terms of being massively underweight equities because we still don't think we're through this period of volatility. And historically, when the Fed pauses, you can get a 15 to 20% rally. So we find ourselves kind of neutral-ish stocks versus bonds. What you'll see in the fixed income, though, is a very defensive positioning. Trying to get aggressive in fixed income ahead of a growth slowdown, Lisa, is like picking up pennies in front of a tractor trailer. So we're neutral-ish with a bias towards being long on the duration call. And we're about as underweight credit as I remember us being in the 15 years I've been here. There's only two other examples that I've seen as this underweight credit, and that's 07 and 2019. In particular, I think if duration was the risk that defined bonds in 2022, I think credit risk could increasingly become the risk that defines bonds in 2023.
Steve, I'm so pleased we didn't lose you to baseball. Thanks for being with us. Steve Chevron there, a Federated Hermes on this market. He's not alone. Oksana Aronoff of JP Morgan Asset Management yesterday just saying no thank you to credit right now. In her view, high yield spreads have no business south of 400 basis points.
I don't know where to go. I read carefully the Johnson & Johnson Kenvue deal yesterday. That's like Lisa Abramowicz territory.
Right.
And I really studied it. It was 6 times oversubscribed. And where it fit in with other, this is Band-Aids, Listerine, Aveeno. That's the products in this new spinoff. And it fit in superior to all the other consumer good companies. The appetite out there for bonds.
For income?
Even here,
that's huge.
Stunning.
Okay.
Stunning.
Huge.
So if you're reading the prospectus of an 8-part bond offering, did you also read the beige book? Are you also going to read the notes of things? I'm just curious.
That's on the edge of minutes. In honor of the late Richard Yamarone, I just go to the orange book that Bloomberg invented, which is more informative.
So you avoid the beige book?
I avoid the beige book.
That's good to know.
Several minutes I avoid.
Nice.
I do listen to the chairman, though. I thought that was fascinating.
You actually watched some testimony yesterday?
Yeah, day 3 will be something.
That's good. I'm pleased you've caught up ahead of payrolls. Yeah. Christian Muller-Glissman of Goldman Sachs is going to join us in the next hour. Equity futures look like this on the S&P 500, down around about a 0.2% or so. No real drama here. Yields down about a basis point, 397.96 on a 10-year from New York. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. President Biden will target billionaires and rich investors in the budget request he unveils today. Billionaires would be hit with a 25% minimum tax. Income taxes on corporations and wealthy Americans would be raised, and the capital gains tax rate for investments would be almost doubled to 39.6%. On day 2 of his testimony on Capitol Hill, Fed Chair Jerome Powell softened his tone slightly. He said policymakers will wait for new jobs and inflation data before deciding how much to raise interest rates later this month. Still, Powell repeated his message that the Fed is likely to take rates higher than previously anticipated. In Israel, tens of thousands of people headed for protests over the government's plan to cut the power to the Supreme Court. There may be demonstrations in 20 cities. Protesters are calling it a day of resistance to dictatorship. Prime Minister Benjamin Netanyahu and his allies say they're trying to rein in a court that has overstepped its authority. In Ukraine, Russia launched a devastating barrage against cities today. At least 5 people were killed. Hundreds of thousands more were plunged into blackouts. The Russians were said to use a new mix of weapons that mostly evaded air defenses. And JP Morgan is blaming former executive Jess Staley for the bank's ties with disgraced financier Jeffrey Epstein. And it's demanding that Staley return all of his compensation for an 8-year period. That's more than $80 million. Just weeks ago, JP Morgan defended Staley against accusations that he knew about Epstein's sex crimes. Staley has denied knowing about Epstein's abuse. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo. This is Bloomberg.
have not made any decision about the March meeting. We're not going to do that until we see the additional data. Larger point, though, is that we're not on a preset path and that we will be guided by the incoming data and the evolving outlook. No decision has been made on this, but if the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes.
Some ifs and a couple of buts. That was the difference between day one and day two on Capitol Hill for Chairman Powell from New York City. You okay there?
I'm fine. No, I'm not okay.
What's wrong?
I read my first article. I think I have to blame the Telegraph in London. And, like AC Milan's not even back to Milan, and they're already talking about the Keene exit. I mean, this is a huge... I'm not thinking clearly today.
Okay.
The Tots have blown it.
Yeah.
They have a very sick coach. Some guy just out on Twitter thinking Beyonce ought to step in and coach the rest of the season. Yeah,
maybe. Let's pick up on that later.
Yeah, let's do it.
If you're just tuning in, good morning to you. Let's get you some price action. Futures down about 0.2% on the S&P. Yields unchanged, Tom. 3.98 on a 10-year.
It is. It's the data flows there. And, John, I think we're finally to where it's the wait. I mean, we make jokes about countdown clocks. But, I'm sorry, we're there. It's 2 hours and 15 minutes, and now everybody's just waiting.
A couple more hurdles. We get claims a little bit later. Lisa mentioned that, 8:30 Eastern Time, then on to payrolls tomorrow, and then it's on to CPI on the 14th and the Fed on the 22nd. One little wrinkle for the Federal Reserve is that the 14th, the CPI print, comes in a quiet period. So no Fed speak around there. That Fed speak ends after Friday.
When's the quiet period end?
Starts Saturday,
June?
And it will end after the Federal Reserve meeting, Tom, because the chairman will come out and snap that quiet period for you. You won't be here, though.
I'm not going to be
We'll
here.
miss you.
I have to go away. Afterthought said nope. And that's what we're doing. Right now we're going to go to Washington. Anne-Marie Horton is with us. She's had a very difficult night. She's our Bloomberg billionaire correspondent and joins us. You've seen her on Billions. Anne-Marie Horton, and it's good, Anne-Marie, to see that you're going to be taxed at 25% along with the rest of the billionaires. What in God's name is going on? For we mere mortals, when the president of the United States comes out and says he's going to tax billionaires at 25%, what does that mean?
Well, this is going back to something the Biden administration tried to push forward. Remember, during Build Back Better, when they first got into office, a lot of these tax hikes and provisions could not get through to a democratically controlled House and Senate. So this is, as Greg Bellier and everyone else has put it, dead on arrival. But Greg Bellier this morning says it's purely aspirational. And I think that's really how you need to view today's budget. In recent years, a lot of these budgets are pretty much dead on arrival. But it shows us two things. One, this is, as Jonathan called it earlier, a campaign event. The president is expected to make an announcement for 2024. And this really foreshadows the future of how the Democratic Party views fiscal issues as well as where they see room in the tax code to raise taxes. Secondly, it's a way for the president to outline his plan. He's probably going to say he wants to make sure to keep entitlements like Social Security and Medicare solvent. And it's a way to start that debt ceiling debate with the Republicans. And then, of course, we have to wait for the Republican response and their budget.
Tell me about the shade of Democrats here. I mean, I get the idea the left wants to tax evil billionaires. That makes sense as well. But, Anne-Marie, where are centrist Democrats on this? Where's Manchin on the edge of Democratic and Republican?
We know where we are. I bring this up a lot, but the Democrats had a chance to close something that helped venture capitalists and private equity managers, which is the carried interest loophole. They were able to narrow that tax in August, yet to get one centrist on board, then Democrat, now independent, Kyrsten Sinema, they had to drop that. So this just goes to show, that is why it is aspirational. It is a ton of measures. None of them will get through. Maybe, if there's potentially one, but no, this is not looking likely for any of these measures that they're going to announce today. But it shows how wide the spectrum is based on what happened in August, based on what President Biden is going to announce today, how wide the spectrum is in the Democratic Party, but also how hard it is to govern when you have such slim majorities on both houses.
Talking about a campaign event, I wonder if we were having day 3 of Jay Powell testimony on Washington, on Capitol Hill, whether the focus would be more on their failure to curb inflation so far or the potential for job losses as they raised rates, which resonates more with the population in America.
It depends what lawmakers asking the question, right? The Republicans want to continue hammer the Fed about inflation and what they say was driven by excessive spending of the Biden administration. That is their line. The Democrats are very worried about going into 2024 and potentially job losses in a recession. And remember, yesterday was a little bit more political even than we saw in the Senate. And that is because also the nature of the House. These are lawmakers that have 2-year terms. In the Senate, it's 6 years terms. So obviously, you saw a lot of political questioning to Powell about inflation that's hurting everyday Americans, about people that are potentially going to have job losses, about mortgage rates, about climate, about capital requirements. This would be day 3 of pretty much the same. But more interesting, we're going to have Treasury Secretary Janet Yellen on the Hill Friday morning. This comes after Biden's budget. And really the question for her from lawmakers is going to be if she could precisely map out when we are going to hit our debt limit.
Another thing that we're going to see in Capitol Hill today is the Norfolk Southern Railway CEO. He's going to be talking about the derailment in East Palestine in Ohio and some of the other concerns that we've seen percolate out. Is there a greater willingness on both sides of the aisle to pass certain safety measures that railways have to implement that have previously been shot down before this derailment?
Mm-hmm. Yeah, I mean, a lot of the Democrats are pointing to this kind of regulation that was rolled back during the prior administration. There is a growing chorus, more bipartisanship when it comes to this issue, right? And you saw both parties try to take this train derailment in East Palestine. Then there was one outside Springfield, Ohio, just weeks later, and put a focus on these kinds of issues and these kinds of safety issues. When you have the media talking about it and you have politicians flocking to Ohio to talk about it and make this campaign events a la the former President Trump giving out Trump water in East Palestine, you now see really growing support that more needs to be done. And if they're not able to pass the regulation, at least today, there will be a grilling of the CEO.
Anne-Marie, thank you down in Washington. Looking forward to the conversation a little bit later in the next hour. Elisa, we've got to talk about what's on the horizon here. It's pretty clear that we're going to have a debt ceiling crisis in the United States. What's difficult for a lot of people in this market is it's too early to prepare for it. Chairman Powell kind of laid the groundwork a little bit over the last couple of days. What was that phrase? There's no rabbits out of the hat. Right. There's no rabbits out of the hat here. They need to do something.
Here's the problem. Every single time there's been an issue with the debt ceiling, they've solved it. Every single issue, they took it to the last minute.
Why is this time different?
And then it was solved. This time, people feel like the lines are more entrenched, and this is actually one of the campaign points among certain Republicans who say, we do not want to expand the budget, and we will go to our grave saying that. And that is just their campaign. That's their platform. So this becomes a much more difficult sell. What's the response to it? People are just ignoring it because they have no idea, and we're not there yet. But it does feel slightly different.
I'm going to give you a singular response, and CBO lays it out. I do not have, John, the numbers memorized in front of me. Guess what? Interest rates up. Guess what? Interest expense of debt. Guess what? These are I thought they were summed cumulative numbers, to borrow from Brainerd. No. Per year, it's unimaginable, the interest cost out 10 years now that rates have normalized.
I think Chair Powell was very specific yesterday. It's about the growth of debt that's unsustainable. He said the debt as it stands is sustainable, but the growth of debt is unsustainable. Is this the time to do something about it? No, because these spending agreements have all been agreed in Congress previously. This is spending we've already agreed to, and this is always the frustration when we come round to this debate on Capitol Hill.
It's the reason why some people are looking at the Biden speech today as a roadmap for how they plan to solve this, because there are two ways to deal with this: cut spending or raise revenues. How do you raise revenues? And I think that's what he's trying to address.
Coming up, Rabina Faruqi, the chief US economist at High Frequency Economics. Looking forward to that conversation. Futures on the S&P down about 8 points. We're negative 0.2%. From New York City, it's a Powell-free zone on Capitol Hill. This is Bloomberg. Equity futures a little bit softer here. We're down about 0.2% on the S&P 500. Likewise on the Nasdaq, we're down about 0.5%. Just a little bit lower, negative down a touch across the board here in the equity market. Confronting some big moves in the bond market over the last couple of days. Your 2-year, 10-year, 30-year shaping up as follows this morning. The 2-year retreating a little bit. We're down 4 basis points on a 2-year. Still north of 5%, 5.0283% over the previous 3 days. Yields higher. This morning, yields just a little bit lower at the front end. So the curve re-steepens just a bit, but look at these levels though. 2/10, negative 104 still. Yesterday, briefly after ADP, we dropped through negative 110. In the FX market, just to round things out for you, Tom, euro dollar shaping up as follows. On the euro side of things, just a bit stronger against the dollar. Euro dollar 105.78, still sub 106 going into payrolls tomorrow morning.
I don't get much from currency, John, but I'm glad you mentioned 2's10 and that we went out to 110, 111. We come back, but still, look at the screen. I'm sorry, 3 days on, it's a shock.
These are big levels, Tom.
These are big
5 at the front end. And then you had the likes of Rick Reeder over at BlackRock floating just the idea that maybe we have to go to 6 on Fed funds.
Yeah, did you see Liz Ann Saunders tweeted Atlanta GDP now?
Where are we?
Modeling 2.6%, and it's a calendar item. We're in March. That's pretty good data in March.
Speaks to the resilience of this economy.
It's distant from recession.
Speaks to the argument we've been having just about how rate sensitive this economy may or may not be.
Yeah, we'll have to see. It can be 20/20 hindsight here. We're going to go to it right now. And Rabila Faruqi is going to give you a wonderful brief. She can do this off the heritage of high-frequency economics, which is hyper-detailed notes looking at the granular data. Rabila, I want to go to one thing you alluded to, which is everyone, including you, doing the 20/20 hindsight look back of what they should have done at the last Fed meeting. We're more informed now. Is it just a layup that they should have gone 50 at the last meeting?
Good morning. Thank you for having me on the show. I do think that maybe it was a little premature moving down to 25, moving down so quickly, slowing the pace to where they did, because we really don't have much clarity right now in terms of the growth trajectory. We know that growth is positive. We know that the labor market is extremely strong. And we know that there are sticky components to this inflation that we're seeing right now. So, maybe it was a bit premature, but, the Fed has done a lot. And I think they're very concerned, as much as they are focused on inflation, they are not insensitive to what, the effect on the economy will be. The problem is that monetary policy right now, if you look at where the inflation is showing up, that's really not very responsive to what they're doing on the rate side, right? In terms of demand for travel, in terms for demand for, going out to restaurants. I don't think that's, that part of the economy is really going to respond to, further hikes in interest rates. But that's the only tool they have. That's what they're going to have to do.
When we look at the American economy, and if we assume the consumer is buoyant, which gets you out to an Atlanta GDP now 2.6%, when we finally get to slowdown, does consumption drift away rapidly?
And that's the question that we're trying to answer. So on the one side, we expect to see job growth slow. We expect to see, some moderation from interest rate hikes, especially when you look at, what consumers are facing in terms of credit card debt, in terms of credit card interest rates, auto loan interest rates, tighter lending standards. So we do think that stress is going to appear. But on the other side of it, we're seeing real disposable incomes that are now positive. If you look at the recent months' data, and if you look at it on a quarterly basis, so there is still support for the consumer. But we think that, eventually these excess savings are going to wind down, and that eventually, this high interest rate environment is going to be a constraint on consumers. Like I said, we've been in the camp that growth is going to remain positive and that the consumer is going to remain resilient. It's just that the pace is going to slow, probably, maybe in the second half, starting in the second quarter. But, we've been growth, spending, these things, they've just surprised to the upside. And it's been very difficult to predict when that pushback from the consumer is going to come.
It seems like right now analysts are toggling between a no landing type of scenario or a delayed recession type of scenario. And I guess the issue that I have is, if we get a delayed recession, will it inevitably be deeper? Because it means that in the meantime, the Fed has had to do more in terms of raising rates or even potentially shrinking their balance sheet.
Right. And that's the other thing that we're trying to, assess is, if the Fed is really, not seeing the improvement in inflation, and we don't think we're going to see the improvement in inflation, not a substantial improvement anyway, you have goods prices that are eventually going to stabilize, towards that 0% contribution. You have a service sector that's still accelerating. The housing component of it that is not going to slow down for a while. So, you're going to see that sticky inflation, which means that the Fed goes harder, and the probability of, a recession, over tightening and a recession goes up with that. I'm not really sure what this no landing scenario is really, if you're going to see growth, that's going to be stronger. If you're going to see inflation, that's going to be stronger. The Fed is going to go more. That means that the hard landing scenario becomes more of a reality. Again, like I said, I don't see negative growth this year. We still think that the U.S. economy, the fundamentals still support positive growth. It's just that there's a wide band of uncertainty around how far the Fed is going to go, how long they're going to stay there, and what that will mean for economic growth.
If I were to sort of characterize Fed Chair Jay Powell yesterday, he basically came out and said, please give us a break, okay? We might go 50, we might not. It all depends on the data, but don't look too closely at one data print. Look at all of them. And God, would you guys just chill out? I mean, honestly, he was trying to basically push back against everything and hedge, and it really just raised the conviction in markets that he was going to go 50 basis points. From your perspective, how low is the bar with respect to the payrolls report tomorrow to get a 50 basis point rate hike from the Fed?
And this is the challenging part, right? I mean, they stepped down to 25, and now we're still looking at a labor market that is extremely strong. 200,000 on payrolls is an improvement, but it's still too hot in terms of, what the Fed wants to see. We're also looking at the wage data, not consistent with the 2% target. We're also looking at inflation. We don't think that next week's numbers are going to show a substantial improvement on core prices. So I do think that they can go 50. We're also looking at the retail sales numbers. We're also looking at industrial production that's going to be reported next week. And we think we're going to see a slowdown over there. So how the Fed balances those things out, he talks about the totality of the data. I think the totality of the data will show that the labor market is still strong, inflation is sticky, but that there is some moderation in terms of household consumption. And they have to balance. It's a very tricky situation that they're in. But I think at the end of the day, I do think my base case is that they do stick with the 25. But if there's an upside surprise tomorrow, and if there's upside surprise on CPI, the 50 is definitely on the table.
I want to go to your heritage and the granularity that you've been known for years. Are we becoming a nation of bartenders? I mean, I look at the hospitality and bar growth, and I get it. We're coming off the pandemic and that. Does the Fed and do you care about the quality or character of jobs?
Yeah, absolutely. I mean, but like you said, we are seeing strength across sectors. This is not just about leisure and hospitality. This is not just about, the sectors that were affected by the pandemic. This is really about pretty broad-based strength. We do care about that. We think that, what we're seeing right now, we're still seeing pandemic effects, but really there is resilience. And in terms of where this economy is, look at construction, look at manufacturing. We've seen a huge adjustment in housing, but we still haven't seen declines in construction payroll. So how long is that going to last? That's what we're trying to assess. It's really not clear right now.
Rubeela, I'm not sure anything is clear right now. Rubeela Farooqi there of High Frequency Economics. Payrolls tomorrow, previous number 517, median estimate 225. Question now is not how high is the bar for 50 basis points. It's how low is the bar for 50 basis points, even with that slight step back from Chairman Powell yesterday.
And that's entirely Jay Powell's fault. And I will argue that he basically laid the groundwork saying that everything's been coming in hotter. Well, no, I mean, that's what he was trying to back away from yesterday was he was like, wait a second, maybe that's not how I wanted to come across. I wanted to give ourselves more room. But clearly they're concerned about the lack of progress they're making. And so, if that's the case, why not go further if all of the upward revisions that we're seeing continue for the previous months as well?
Makes you wonder, who do they run this testimony by internally at the Federal Reserve? Who read that on day one?
Or
it doesn't make sense.
Who doesn't understand what the markets read is going to be?
Clearly there's a disconnect there.
And I think that that's really the issue, and that's been a tension consistently. They don't know what they want to signal to markets, and if they don't have that that clarity, then you get some of these communication issues that get borne out in market pricing.
So this is going to sound really, really harsh. It's not meant to. But if that's an area in your expertise that you lack, why lobby to have an economist at the New York Fed and not someone who understands markets, someone that you can speak to and rely on?
I'm not going to answer that. I'm going to punt that one. But
By all
I will
means, you
say,
can.
But
that's what happened with this Federal Reserve. It's well reported and well understood.
I would say there is a tension between understanding how much the Federal Reserve cares about the market's response to what they do, trying to lead versus trying to follow. There is this consistent tension that's been there for the past year. And I think that just continues with this feeling that perhaps they're not trying to job on the markets until they are.
I just found the communication, Tom, over the last couple of months pretty bizarre.
Months. I would go years, and I would go back to the advent of the dots and all this speakathon that we have every 6 weeks that Lisa's been great about keeping up on. I just think there's too much communication. And what's interesting here, John, is they have a historic data dependency, and now that we're much more restrictive with the seismic move in rates, the markets have caught up to this insane focus on data. It's always been there. It's just now in very bright lights.
So I think the radical transparency coming out of the financial crisis made sense. They became so powerful through the financial crisis and afterwards. And also they wanted to use forward guidance to really bring interest rates down, lower for longer, a whole lot longer. Now what's happening with the forecast, it's not so much about the dot plot, it's the fact they're projecting higher unemployment. And that seems to be part of the objective. And that's where they're going to get in a little bit of hot water down in DC, and I think we've experienced that over the last couple of days. This just gets worse, though, doesn't it? I mean, let's face it, this is happening now with 3.4% unemployment. What do those testimonies sound like if Chair Powell sits down again and that's got a 4 handle or a 5?
This is the reason why there are people who think that perhaps you could see longer-term yields go up, because there won't be the conviction at the Fed to go all the way because of the concerns about the employment picture. And that's sort of some of what people are trying to game out. The problem with radical transparency at a time of such uncertainty is the Fed doesn't know. They're arguing about their framework, they're arguing about the models to follow, and they're arguing about the historical analogs. So radical transparency doesn't leave us with much clarity.
It's clear that the job is easier when inflation is really low, and you just have to sort of max ease. And I remember the days when they would say, yeah, but we know what to do when inflation is too high. We raise interest rates, and this is the world they're struggling in.
Here we are.
Here we are. Futures down 2/10 on the S&P. Coming up a little bit later, Christina Campmany of Invesco. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Biden administration will unveil a new budget proposal today that officials say show a commitment to cutting the deficit. Sources tell Bloomberg it calls for a 25% minimum tax on billionaires, will nearly double the capital gains tax rate for investment, and will raise income and levies on corporations and wealthy Americans. Now, that plan has little chance of passing in Congress now that Republicans control the House. Senate Republican leader Mitch McConnell has been hospitalized after falling Wednesday night in Washington. An aide said McConnell tripped during a private dinner. No word on how badly he was hurt. McConnell is 81. He was elected to the Senate in 1984. The UK plans to relax some data protection requirements under the European Union law. The bill includes reforms that would make it easier for British companies to mine user data and research and development. Businesses have cautiously welcomed that move. Privacy groups, though, are critical. Crypto-friendly Silvergate Capital plans to wind down operations and liquidate its bank. Silvergate collapsed amid scrutiny from regulators into dealing with falling crypto giants FTX and Alameda Research. The bank sold off assets at a loss and shut its flagship payments network. And Credit Suisse has delayed publication of its annual report after last-minute questions from U.S. regulators. The Swiss bank was due to publish the report today, but the SEC had questions about revisions Credit Suisse made to previous cash flow statements. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
With 200,000 plus people, you have a normal turnover rate. Actually, it's it's starting to go down to an all-time low again. The reality is you can manage that head count. And so we'll redeploy people across the franchise, including investment bankers to other parts of the franchise to help us in the middle market investment banking. So you can move it. Our headcount peaked in January. It's down a few thousand. It can move, but you had to stop hiring, and that's what we had to do last fall.
Bank of America is not Credit Suisse. That was Brian Moynihan, the Bank of America chairman and CEO, catching up with Francine Lacqua. Credit Suisse wishes it was Bank of America at the moment. B of A is doing okay. Credit Suisse, anything but this year. The stock is down another 5% in early trading. Down 5% to 253. And here's the latest, that Credit Suisse has delayed the publication of its annual report and compensation details for 2022 after US regulators raised last-minute technical queries, Tom, on previous statements. Just a tricky time. We're down about 8% over the last 3 days.
Excuse me, I'm coughing, gasping out loud, waiting for the jobs report. I think, John, that this is the measurement of different assets, and then from the measurement of those assets, appropriate ratios of some form of coverage. And in the murk we're in, they have to clarify how they measured those assets. That would be my truly amateur take.
Yeah, I don't know, but I do know it's been a tough week for this company. Started out the week with David Herro of Harris Associates, long-time shareholder, one of the biggest shareholders of the bank, backing away and standing his stake completely, and essentially communicating through the media, through the Financial Times over the weekend, that there's just better opportunities in European banks right now. That sector's delivering.
The 3-day chart shows it all. Bring up the 3-day chart if you can. On radio, all you need to know is it is a substantial move, as John mentions, off of the Harris Associates exit, and then the shock of what we've seen this morning as well. Expert on this is Jan Patrick Barnard. He's in Frankfurt with us with some serious financial cred as well as his journalism. What is the urgency this afternoon in Zurich, Jan Patrick?
No, I bet it's pretty high, and I guess the urgency in Zurich is on a high alert level for the better part of the last year, I would say. So, I mean, here we are again. The bank really struggles to get anything right at this point. It's like bad headline after bad headline, and that's reflected in the stock price, as you pointed out. I mean, if you look at Credit Suisse compared to the European banking sector, you have a performance gap now over the past year of 100 percentage points. I mean, that's just amazing.
I look, Jan Patrick, at the reality in America mostly by what we call perspective. That if a stock goes under $5 per share, many institutions have to sell. Is there a breach at 3 Swiss francs? Or moments ago, almost going through 2.50 Swiss francs, or dare I say it gets to 2? Is there a point where institutions are forced to sell?
Well, there's no point where they are forced to sell in to that degree, but I would say, like we see, and that's part why the share price is so much under pressure. There's very little incentive or very little prospect for any investor to buy Credit Suisse shares at this point, unless you have like a very deep pocket and a very long breath to stay this out. The problem is the bank has done nothing, really nothing, to show investors that they're turning the ship around. So why would you be engaged in that stock except for it being cheap on paper? But the thing is, as it's playing out right now, you don't know. You have to check your ticker every morning. Is there another bad headline coming out? And that's not a foundation, I would say, for an investor to be happy to be in a stock if you from the get-go are like in a state of nervousness and cautiousness. So that makes no sense.
Let's build on that, Jan Patrick. Earlier this morning, John asked the question: is there any good news that we keep getting, or that we have gotten from Credit Suisse? Is there any good news that perhaps has been drowned out by the litany of bad headlines?
Well, I would say, like, in general, I mean, they're trying, right? I mean, like, they have a plan in place. The problem is just, like, so far it's not working, right? So if you want to make a buy case for Credit Suisse here, you can say, like, the stock is super cheap. A lot of the bad news is certainly priced in. And now all they need to do, is just like turn it around, produce some good headlines, show us that the financials are going into the right direction, that they stop the outflows. It sounds easy, but it's probably not for Credit Suisse right now, because, like, think about like the day-to-day business right now. All the relationship managers have again called their clients and explained to them what's going on, instead of like going after new clients and building business and building relationships. So that keeps them occupied, and that will then feed through to the financials. So, and that the bank is just busy with itself and can't really like focus on on their core business, so to speak.
Jan Patrick, I'd love to dig a little into the allegations here. This idea that the SEC raised some concerns about previous financial reports that they said weren't going to necessarily get refiled. What's the more unusual aspect about it? The SEC disclosure, or that they delayed an annual report, which is usually on time?
Well, I would say this is both highly unusual, and it shows you like the core issue at Credit Suisse. I would guess like if something like that, some technicality or whatever it is, happens with another bank, it's a good thing that the regulator is asking questions. But would they force the bank to delay the report? Maybe not, right? And that shows you that Credit Suisse is in such a dangerous state, I would say, like that the regulators are very nervous and that they are extra cautious with everything that Credit Suisse is doing. And of course, if I would be a regulator and a bank that is not in good shape is like starting to change the numbers, I have some questions too. So it makes total sense, but it is highly unusual.
Jan Patrick, you used an important word there. You said dangerous. What's dangerous about it?
Well, I would say, like as I said before, like banking is a business of trust, and especially for Credit Suisse, and they're losing it day by day by day with all those headlines and all those issues that they are producing, and the share price goes lower and lower, and at some point, I'm not sure if capital becomes an issue again, but think about if they have, like in the course of this year or the next 18 months, have to go to the market again and again ask for fresh capital. It would be horrible, and I think that is the big danger for Credit Suisse here, that they really fail to turn this around. They're losing money, they burn through capital, and then you never know what's happened if you find enough investors again that are happy to jump in there.
Well, these aren't conversations we have lightly, but are you suggesting they face some kind of existential risk?
Well, that's a tough question to ask, and I mean, like, I want to give them credit that they're at least trying and to turn the ship around. And I mean, it's still a 10 billion franc bank, so it's a major institution. And I guess, like, before we really get to the existential question, a lot of other things have to go wrong. But the problem is, like, the trend and the dynamics right now are very dangerous, and they have to, at some point, they really have to do something forceful to turn this around, just to avoid this discussion at all costs. Because, like, the existential thing with a bank does not start when it's actually there. It starts when people talking about this, and we saw this with Deutsche Bank at some point when they were in bad shape. So Credit Suisse has to do everything they can to produce some good headlines, to produce some good financial data over the next couple of months and quarters to get people not even thinking and talking about that problem.
Well, let's hope that soon, for their sake. Jan Patrick Barner, thank you, sir, of Bloomberg on the latest with Credit Suisse. The beleaguered bank down another 8% year to date. On the session, it's down 5%. The problem with Credit Suisse right now is this is happening against the backdrop of where European banks are doing pretty decently. We're talking about 30 points of underperformance here. You've got the Euro stocks banking sector right now, Tom, up 22% year to date. At the same time, Credit Suisse is down on the year.
The way I'm looking at this is there was a day where Jamie Dimon had to stand outside the front door of Bear Stearns, like, down Park Avenue. John, you go down there. Lisa runs down there after the show just to see what's going on. And the American banking system dealt with a huge challenge with Bear Stearns. I'm not equating this to Bear Stearns, but I'm absolutely baffled, as John Patrick nailed, the Chinese water torture of this. I just don't get it.
Well, part of it is because it's not Bear Stearns, because there isn't that systemic risk, because it hasn't been a capital issue, because there haven't been this sort of systematic connections, that connectivity that's been sort of beaten out of the system after 2008. So that kind of has prolonged this for even further than it otherwise would have been, and raises the question, well, how long can they just subsist, even with all the negative headlines, if they've got some capital, they've got some backers, and they have some income?
The big challenge, and I mentioned it just in terms of what David Harrow of Harris Associates said, people will see better opportunities elsewhere, and arguably that's what's been happening over the last couple of months. It's not just the water torture of the drip, drip, drip of bad news. It's the fact that you've got some good news elsewhere. That's the real game changer.
So Sunday, March 16th, 2008, they fixed it. They said, Mr. Dimon, walk across the street to Bear Stearns and get this solved. They've got UBS in town. What are they waiting for is what I don't get.
But to your point, who wants to go in when you've got alternatives, right? You have the Middle East, that you've got Middle Eastern investors that are saying,
yes,
we can use Credit Suisse and we can go and we can invest so that they can be our bank. And then how much does that kind of discourage other capital for coming in if people are looking for control for very specific reasons that don't have to do with returns that you get potentially from some of the other financial
That's a point really well made, Lisa.
Their equity on the Bloomberg terminal. Are you ready?
Sure.
I've never seen this. 4.5%. They are 95.5% debt. I've never seen that. That's how bizarre this is.
This stock right now, 253 on Credit Suisse. Up next on this program, Christian Muller-Glissman, the Managing Director and Portfolio Strategist over at Goldman Sachs. From New York, this is Bloomberg.
We're in data that is really having trouble sending us a clear signal.
The adjustment we've seen in markets has been quite small given the news that we have from Powell.
It's important that he laid out just how data dependent they are and the willingness to pivot.
The Fed talks too much. I have thought that throughout this whole cycle. There's too much talking, too much talk of disinflation.
If we are going to consider reaccelerating to 50 based on the data, and they are very data dependent, the risk of a hard landing does go up.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures negative about 0.2%. A little bit later this morning, jobless claims in America. Then, Tom, it's on to payrolls Friday. And I think we're all asking the same question. Just how low is that bar for a 50 basis point hike from this Fed after testimony from Chairman Powell?
To me, it's revision Thursday and into revision Friday. To me, the revisions, as I said yesterday, John, is everything out there. They've never been more important in the narratives. Can I just say, John, that this show is forever scarred by you. It's your fault.
What's happened?
We're going to show opening, folks, and we talk right up to the opening, and Bramo's talking about Verstappen.
I know.
I mean, that's how bad we've descended down the rabbit hole.
I won't go any further about what we were talking
about.
Please,
thank you. I appreciate that. Some discretion. Thanks. Let's talk about rates.
Whenever Tom says, let's talk about what we talked about in the break, I think everyone's sitting there nervously.
Is Verstappen with the Bundesbank? I can't remember.
No, but if he was, he'd be asking for higher interest rates, no doubt.
Good segue. Love it.
Don't you think? He's on board with everyone else. He's got lots of savings, Tom. I'm going to whip through the price action. We're not even going to have an opening conversation this hour. Futures negative 0.2% on the S&P. You've heard from Chairman Powell for 2 days. That's all over with. Slight walk back on day two.
Slight, yes.
Some ifs, some buts. Ultimately, the maybe comes down to the economic data. It's payrolls tomorrow. It's CPI on the 14th, Tom, and then the Fed on the 22nd.
VIX 19.46. I know that all the adults tell me the VIX right now is not giving me good information. You know what? It's there. And equities have sort of kind of like been immovable given the fixed income narrative, the economics narrative of the last 48 hours.
Lisa, the 10-year just in and around 4% right now.
Let's see how the narrative shifts in perhaps a half an hour or perhaps an hour. We get the data dump that includes challenger job cuts at 7:30 a.m. One of these peripheral types of measures that take on new importance in the era of data dependency. Initial jobless claims come at 8:30 a.m. Do we get a sense of the ongoing strength that we got yesterday from the JOLTS data? You can look at some of the quits rates for possible softening, but the bottom line is 1.9 job openings for every unemployed American, close to the all-time high record of just north of 2 jobs per every unemployed American. This is unsustainably hot for a Federal Reserve that has not seen the progress that they're looking for. Perhaps we'll get more on that from 10 a.m. We get Fed Vice Chair for Supervision, Michael Barr. He will be speaking about crypto. Perhaps we'll also talk about what we heard from Jay Powell, 50 basis points, what the threshold looks like. And in related central bank speak, it is the last meeting for Governor Kuroda over the Bank of Japan tonight. His term ends on April 8th, and this a lot of people are looking for to get a sense of, A, whether he wants to open the door to potentially moving away from the yield curve controller or widening the band even at a time when the 10-year Japanese government bond keeps trading above it. And today, President Biden will be releasing his campaign speech or his budget proposal, whichever one you want to say. It's going to include a host of tax increases, including a 25% minimum tax on billionaires, as well as eliminating that carried interest tax break, a number of other proposals that a lot of people say are dead in the water. It will be interesting, though, to see, again, the contours of the debate raising the debt limit, or basically how do you deal with the debt ceiling, given the fact that basically you either have to cut your benefits or you have to raise revenues, one or the other, and it's clear which side he's taken, John.
Dead on arrival is in pretty much every single headline in the United States this morning. Lisa, thanks for that, Tom. That seems to be the headline.
We have a jewel, the Congressional Budget Office. It will analyze those proposals. I'm sure they'll be told by a GOP member at gunpoint, you've got to analyze those 4 items. But the answer is, you can look at the analysis and be afeared. The heart of the matter is, John, are we growthy enough to handle our debt? That has changed in the last 6 months with this new higher interest rate.
I think the chairman was pretty clear in testimony over the last couple of days. The growth of the debt in this country is unsustainable.
I mean, I'll be honest, in the IMF meetings in April, I'm reading a lot about this, getting up to speed in this new world. It's a new world for Washington.
It's a whole new world.
After all.
Thank you, Tom. Christian Muller-Glissman, Managing Director
It's like
for Portfolio Strategy at Goldman Sachs. We're not going to start singing, Christian, don't worry. Let's talk about how low that bar is for 50 from this Federal Reserve. What would we need Friday morning, tomorrow, and on CPI day next week?
Yeah, I mean, listen, I think it's all about the trend, and the Fed wants to see a downtrend that's convincing. I think we had this blockbuster print last time, so there is going to be a downtrend. How much? I think consensus is looking for 200,000 or so. I think we're at 250 on payrolls, so we're a bit above. I think, is that enough to push the Fed to 50? I think you need to put it in context with the inflation data, with the average hourly earnings. We're actually expecting average hourly earnings to be a bit more moderate, in line with consensus. We're a bit above on the inflation side as well. But our economists actually kept the 25 bips. And I think they feel like it's making sense for Powell to open the door to 50, but to step up after you step down, I think that is still a significant step. So the question is really if there's some type of blockbuster surprise to the upside that can get them there. I think with the current data set, our economists kept the 25.
Christian, let's go to Tony. You did this at the Warwick Business School years ago where John attended. Christian, I'm going to look at your phrase, macro momentum. I think this is incredibly important. Physics envy of the mass of the system, the velocity of the system, which leads to an immovable macro momentum. What is the macro momentum right now?
Yeah, I mean, like the challenge is, exactly as you said, the momentum is actually really good. I mean, you've had the PMIs, new orders over inventories. A lot of the leading components are confirming what markets have been pricing now for 2 months or so, which is that the global economy is kind of accelerating actually, and the US is not decelerating as much as anticipated. So the momentum is positive, and we've taken the credit for that already. That's the big problem. You mentioned it, the VIX is kind of 18, 19, 20. If you compare that to the MOVE index, the type of rates volatility we're currently generating, it tells you like the market already discounts that better growth, because otherwise equities would have suffered just like last year from the rates volatility. So my sense is growth momentum is very good. The challenge is that where we are in the cycle, to your statement with regards to state variables, we're still late. We still have unemployment very low, inflation very high, risk premia very low. That just creates a bit of a tension between momentum and where you are.
I was looking at your allocation as you look at this mess that we all are looking at and trying to understand where we're going. And it says that your neutral equities and credit underweight bonds, overweight cash and commodities. Underweight bonds. How counter consensus is that and why?
Yeah, I mean, listen, I think, as you know, like our view has been that rates volatility over the course of the year is fading, because you have peak inflation, central banks are closer to the end of their tightening cycles. And now we have this new burst of rates volatility because inflation is stickier, there's reacceleration risk. And we need to get through that. In this process, we have to be clear, we're quite advanced. The market has repriced the peak rate for the Fed, for the ECB, and it looks much more symmetric. We've kept the underweight at this juncture. We've had the underweight for a few weeks now because we feel like it's a hedge for the portfolio. In case there is really this type of blockbuster data that scares the market. And a lot of conversations we currently have with clients evolve around maybe monetary policy is not as effective anymore in tightening financial conditions and possibly getting demand under control. If that narrative gains traction, you could easily overshoot peak rates that are currently priced. And that means that, you want to probably have a bit of a short duration bias and be careful to go back to bonds too quickly. But we have to be clear, the yields that we're starting to see in the front end, they look much more symmetric.
How would I play offense in that world? What would I do with my portfolio to set up for that story?
In terms of rates?
In terms of equities?
Yeah, in terms of equities, I think we need to go to the sources where there is the biggest growth momentum, of course. And I think we've been quite focused on Asia, both Asia ex-Japan, China, and also we like Japan, which is linked to growth in the region, but always has a certain global growth linkage. It does have incremental catalysts via the BOJ policies. So we've been very focused on non-US markets to kind of add cyclical risk tactically. There's a bit of a setback on some of those trades because, you have a bit of a kind of moderation of the narrative and obviously risk appetite. That could actually create a good opportunity to revisit those into that better momentum at this juncture.
Christian, thank you. Really fascinating stuff. You said a lot there in the last 10 minutes. Christian Müller-Glissman there of Goldman Sachs. So much to discuss. So last year, the big problem was this volatility around trying to price the so-called risk-free rate. And we thought after we closed out 2022, we'd come into 23, we'd dealt with that story and move on. Because if you can't price the risk-free rate, how do you price risk? Then all of a sudden, month of February, we're doing that game all over again. I'm not sure where to start with Christian there. I keep hearing more and more from people, the international story, Japan, China, Europe. Look at these moves in Europe. The bank's up by 22%. It's pretty phenomenal year to date.
This is really the issue. Do you still lean into risk at a time when the economy keeps outperforming? To me, one of the big takeaways was this question of duration risk versus credit risk. Are you looking at ongoing concern about duration with the rate volatility that you talked about last year, causing perhaps a greater amount of inflation getting priced into the system? Or do you lean into this idea that we have a good economy? Do you go into what's working because it continues to work regardless of what people think should happen?
I mentioned Johnson & Johnson and whatever their new name is for Band-Aids and Listerine and Aveeno, but that was a feeding frenzy yesterday for quality bonds and particularly out long duration. Long ago and far away, one of the magic moments, John, of my ute was I had a meeting with John Templeton. It was set up.
That's very cool.
Very, very cool. I won't go into it right now, but I will never forget the gentleman from Tennessee telling me there will be a shortage of bonds. I don't understand the dynamics of the shortage of bonds as rates move up because we've never seen where we are right now.
Torsten Slok of Apollo just put out their report over at Apollo on credit markets. Here's a stat for you. 15% of high-yield bonds trade with a yield higher than 10%. 15%. I mean, high yield's kind of like high yield now for the first time in quite a while.
The question is, does it deserve to be, and should it be traded even with higher yields based on the rate regime we're in?
I got back to Oksana Aronoff of JP Morgan Asset Management yesterday. She's just not ready to buy it here. She thinks you'll get opportunities this year, just not now. Just wait.
She's waiting on high yield.
She's waiting. Be patient. That's her message. Futures right now down about 0.25% on the S&P. Up later in the next hour, so in about 48 minutes from now, we'll speak to Andrew Sheeds from Morgan Stanley.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden will target billionaires and rich investors in the budget request he unveils today. Billionaires would be hit with a 25% minimum tax. Income taxes on corporations and wealthy Americans would be raised, and the capital gains tax rate for investments would be almost doubled to 39.6%. In Israel, tens of thousands of people headed for protests over the government's plan to cut the power of the Supreme Court. There may be demonstrations in about 20 cities. Protesters are calling it a day of resistance to dictatorship. Prime Minister Benjamin Netanyahu and his allies say they're trying to rein in a court that has overstepped its authority. In Ukraine, Russia launched a devastating barrage against cities today. At least 5 people were killed. Hundreds of thousands more were plunged into blackouts. The Russians were said to use a new mix of weapons that mostly evaded air defenses. The only Goldman Sachs banker tied and convicted in the global 1MDB scandal is sentenced today in New York. Roger Ung says he suffers from a substantial mental health condition and shouldn't receive the 15-year term that prosecutors want. The government says Ung was a key figure in the conspiracy to loot the Malaysian fund of billions of dollars. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
I think it's going to be somebody not named Donald Trump. We know that we lose with Trump. We lost the House in 18. We lost the White House and the Senate in 20. We lost the Senate again in 2022. We didn't win nearly as many seats in the House as we should have in 2022, largely because of Trump. Our voters more or less know this. So I think the fact that we want to win, we know we need to nominate somebody not named Trump, and if we do, I think we'll win the White House.
Well, the party's moved on since that guy was in power. Paul Ryan there, the former US House of Representatives Speaker from a number of years ago. Tom from New York City this morning. Good morning. The conversation that he had when he was in that house, Tom, it looks like we're going to be having those conversations again a little bit later this year.
And is it going to be tinged with Ryan GOP tone or Trumpian GOP tone? That's a huge challenge, not only for the Speaker of the House, but for the Republicans in the Senate as well.
They weren't just the Trump tax cuts, were they? They were the Ryan tax cuts that he'd wanted for a long, long time.
Yeah, and maybe to the defense of President Trump, they were everybody else wanted him tax cuts as well. I mean, I'm not sure how loud the call for tax increases is right now.
Is this what the president's doing today? It's the final effort, the final push to try and campaign on the reversal of the Trump tax cuts?
Brammo, give me an answer. I don't have one.
There are a number of provisions that are just direct reversals, including increasing the corporate tax rate to 39%. It's just basically rolling back some of what we saw. There are, though, these other aspects that did not get passed, including the carried interest provision and some of these other corporate tax breaks that, reinvestment risk with real estate that have been on the table but never fully passed.
They couldn't get it done.
Exactly. And I think that tells you a lot. It also shows how hard it is to reverse something that's really popular among a lot of people.
Huge focus for us the next 40 days, and fiscal will be front and center in our trip to Washington for the meetings of the International Monetary Fund. She is in Washington, Anne-Marie Horton, our Bloomberg budget correspondent. Anne-Marie, I looked at Japan, which is what we don't want to do. The numbers in Japan I thought were misreported overnight, looking at nominal and real GDP. Bloomberg did a great job on that. The real GDP statistics in Japan were shocking with somewhat elevated inflation. But now, this didn't work out like Kuroda wanted it. And the simple answer is a survey number on real GDP in Japan came in elevated, and the actual number that we got was way below it. That's the CBO's worst nightmare. The CBO leads with nominal GDP, Anne-Marie, and they just say there are challenges out front. Tell me about how Congress will model this with the present politics.
Well, the challenges out front, I think, were on full display the last 48 hours, right? When Jay Powell, the Fed chair, was testifying in front of the Senate Banking Committee as well as in front of House lawmakers, and all the economic issues and the politics at play. The questions were there. It's about higher inflation. It's the concerns about what does this mean to have a rate-rising regime, and what does that mean for the unemployment rate going into 2024 when some of these lawmakers are up for re-election? They do not want to see a recession. That tense moment between Senator Warren and Jay Powell put on display exactly what is happening in the American economy. It also, there was a subtext to that which really highlighted what many in the Democratic Party view inflation different from the Republicans. Republicans say this is excessive fiscal spending from the Biden administration, and many in the Democratic Party say you have to look at the rest of the world. There's higher inflation in Europe, there's higher inflation in Asia, and there are things that the Fed can just not control, like Russia's invasion of Ukraine, supply chain kinks, etc. This is the tension that is playing into the politics.
Do any of the politicians understand the linkage of the higher interest rates their constituents are enjoying and how it plays over to the budget? I'm looking at a chart in the 16 charts, page 10, that the CBO published in the last 48 hours, I believe. Do they understand that that chart is move to a higher interest rate regime?
I'm sorry, I have not seen page 10 of the CBO report, but what politicians are concerned about with higher interest rates is higher mortgage rates. And this was brought up by a number of senators and congressmen and women on both sides of the aisle. They are concerned that it is becoming...
Yeah, of course she does.
It is becoming much harder. It's becoming much harder to afford a mortgage in America. And to John's point the other day, it's also much harder to just buy a home outright, right? You know, you're looking at what one senator said, he got a hell of a deal when he thought it was when interest rates are 10% in the late 90s. But to John's point, the house was probably much more cheaper.
It's the boomers, Anne-Marie. The epicenter of the problems.
Oh, man.
It's not.
Trying to create problems.
Just, it's not. AMH, that was a tremendous comeback, and I wish we had a shot of Tom there. It's just like... What do you mean you haven't read page 10?
And then us laughing.
No, I'm sorry. It's all in English and it's all clear. And what's changed is the interest rate regime.
Can I pick up on these proposals from the president? MH, we often talk about the division, perhaps, between what Washington, D.C. would like to do and can do and what the rest of the country would like. Just how popular are some of these proposals that the president is offering, whether they see the light of the day or not, whether they are dead on arrival or not? How popular are they?
They are popular. Higher taxes on corporations and the very, very wealthy of America are popular. This polls well. This is also why the president, even though he knows this has no shot at getting through Congress, is going to have almost campaign event. This is a budget unveiling, and he's taking it on the road to a swing state. He's going to Philadelphia. And why? Because this is going to land well with the public. So this really isn't about a budget. This is about where the future of, one, his campaign may go when he decides to run for re-election for 2024, and two, the future of the Democratic Party and how they want to differentiate themselves from the right.
Just quickly, Anne-Marie, since the rate picture is so important to all of these debt discussions, how likely is it that Janice Eberly, the Northwestern University professor, who is the likely pick, that's at least what's being reported, to succeed Lael Brainerd on the Federal Reserve, how likely is it that she could be put into that post, nominated and confirmed, in the very near future?
Well, first, she is the likely candidate at this moment. She's had a number of interviews in the White House with key players like Lael Brainerd, the new NEC director, and of course that's the job she'll be taking, Treasury Secretary Janet Yellen, from what we know, but she has not sat down with the president. So until she sits down with the president, we don't know if this is a done deal. The issue the Democratic Party has right now with this candidate is that, and this was also on full display the last 24 hours, there is a number of lawmakers that are really pressing the Biden administration to pick a Latino economist for this job. They say that there's never been a Latino on the Fed board, and this is an opportunity for them to have this moment. And 34 lawmakers signed up with Senator Menendez's letter to the administration, and then a number of them used their time with Fed Chair Jay Powell to reiterate this concern. So this is potentially a roadblock for the Biden administration with this potential frontrunner.
I'm going to ask a question, Anne-Marie, and I'd love your insight on it, maybe even just your thoughts if you haven't even got any conclusions. But I just wonder how seriously this administration takes the Federal Reserve. And the reason I ask that is because we were all waiting to see who would be the Fed chair. Do you remember that Thanksgiving a couple of years ago? They dragged their feet on that. They drag their feet now. And I think it's interesting that they needed a new NEC director, and they just said, yes, sure, Fed vice chair. It's not like anything important's going on at the Federal Reserve right now. We'll take the number 2, and then we'll figure it out. I get why we take it so seriously, because it's a big feature of what we cover every day. Is it that important to them?
I think it is important to them. I think there's 2 issues at play. One is that this isn't just about picking someone they think is going to do a good job and that they have faith in at the Fed. It's also shoring up the votes in a Senate where they have a very slim majority. So if you have senators that are now saying this needs to be a Latino pick, that is going to make it much more difficult for them to then go back and decide who can get those votes, right? This is Senate confirmation, and that's really part of the problem.
AMH, thank you. Dan in Washington, important perspective on things. I think there is a suggestion at times that, based on the way they've acted around some of their picks, Tom, that it's just not that high up on the list of priorities.
She was talking there. I was reading page 11.
I still, I know it's ages ago, but what took so long to renominate Powell? I still don't get it.
People think that it was one reason they didn't raise rates soon enough, and that it ended up being a policy error.
Equity futures a bit softer this morning. Good morning to you. Thursday morning. No Chairman Powell. We've had 2 days of that. sure you're full of it and don't want any more. Futures down about 0.25% on the S&P. On the Nasdaq, we're down about 0.5%. Yields still in at around 5% at the front end on a 2-year. Yields higher for 3 straight sessions on the 2-year yield. We're down about 2 basis points this morning off the back of that 3-day streak. Down to about 5.05% on a 2-year. On a 10-year, still sub 4%, but pretty much there, 399.73 on a 10-year. The difference between the 2 and the 10-year getting tons of attention yesterday after a strong ADP report that you tell us every single week, every month, doesn't matter, and then you trade on it. 2s, 10s dropped to below negative 110 basis points. They're now back to about negative 105, the difference between the 2. And just to round it out, Tom, in foreign exchange, it's not just the hawks out of the Federal Reserve this week. It's over in Europe too. The ECB talking up 50 basis point moves. We had Holzmann of Austria saying maybe four meetings in a row. I think the Italian central bank governor came out this morning and said, I don't appreciate people coming out and talking about upcoming meetings. So that was the pushback.
I like the idea that we're now at a point, and there's been a number of people that have written this up this weekend past, where it's now the level of where interest rates are creating a real tension and a nuanced tension here, there, and everywhere. The street loves to look at spreads. The street loves to look at dynamics, the first, the second derivatives. The public just looks at the level. I haven't looked at the 30-year mortgage this morning, but it's above 7%. That's the only level that matters, is one example.
In and around that level, yeah. And we're trying to work out still at the Federal Reserve, Lisa, if we are, quote, sufficiently restrictive.
Can you imagine if Fed officials came out and said, I don't appreciate what Neil Kashkari said. The fact that he came out with some more guidance.
That would make it a lot better, wouldn't it?
He basically saying, we agreed to be forward, have no forward guidance. Well, that's forward guidance. I think it would make it more interesting.
What did Christian Horner called Formula One? Kardashians on wheels. What would they call that at the Fed?
Kardashians at the Federal Reserve. Can you imagine?
Important, yesterday, the 30-year bank rate mortgage out to a new recent high, 7.13%.
Amazing.
I did not know that.
Amazing.
All right, let's take a look at some of the stocks that are moving today. Let's talk about Silvergate. Silvergate's not having a great day after coming out and saying that they want to have an orderly wind down of bank operations and a voluntary liquidation of the bank because that is, quote, the best path forward. Basically, they're also saying that the wind down and liquidation plan does include full repayment on all deposits. Shares are now lower by 51%. The concern here is what other shoes are there to drop within the crypto industry fallout? This had become a bank that really bet the bank literally on crypto and is suffering the consequences from it. We'll talk about that more coming up. It is spin-off Thursday. I want to just make a point that we've been seeing more of these spin-offs and breakups. Spin-off Thursday. GE is expecting its profit margins to widen at its aviation division after spinning off that particular jet engine unit. So this is going to be interesting. And those shares are up by a whole 0.8%. And then Uber is exploring whether to spin off its Uber freight logistics arm in a sale or separately traded
I didn't know they had one.
I was going to say.
Oh, that's actually been a big
delivery?
issue. No, this is actually one of their biggest, one of the side businesses. Logistics is everything. I'm a big believer in logistics. People come there not plastics, logistics. I am a complete believer in it because that's how you basically strip out the inefficiencies in shipping and supply chain disruptions. If you can understand how many drivers to get to a different place.
Right, yeah.
It's a big issue, especially because keep going. Truck drivers are, there's a huge shortage of them.
Can you just see the modern redo of The Graduate?
Why did you come in?
With a cocktail
in? Riveting.
And she'd be like logistics.
Did you not realise it's spin-off Thursday?
I guess so. Can I point out for Mr. Culp, who came into GE and parachuted in Boston, off the gloom of 2 years ago, the stock has done a double. I just, within the world's going to end for General Electric as we know it. Mr. Culp has managed a double.
Well, and is spin-off going to be the solution to the conglomeration that we saw 10 years ago? And this is sort of how it goes in cycles. Everybody get together and then, cycles turn in.
Is there a special later on Spin-Off Thursday?
There's a special on logistics, and I'm so there for it.
Awesome. Can't wait for that.
Time is urgent right now as we go to Friday.
You can tell.
It really, time is urgent. Christina Ketmany with the Senior Portfolio Manager, Global Debt at Invesco. What's the first thing you look at every morning when you look at debt on the Bloomberg? Where is your focus in that broad term?
I mean, I think you have to look at Treasury rates given how focal the Fed has been and where we are. And I think, exactly as you said, the curve has been in focus for everyone. And then FX across the board, right? FX, I think so far this year has presented the biggest opportunity, and it's moving a lot. So those are our two kind of focuses in the morning.
You're not in Camp 50. Why are you not in Camp 50?
Look, I think Powell muddied the water a bit this week, for sure, and the chances of that are higher on the table. But I think they make their, even the communication this week, and there was a little bit of backtracking yesterday, but not quite. And we obviously get payrolls tomorrow, and we get CPI next week. But to go back and justify that we step down 75, 50, 25, back up to 50, it kind of puts you in a place that you need to go 50 again in May. Again, can they do it if you have really strong data tomorrow with payrolls and CPI?
Yeah.
For sure. But I think if you go back to some of this Fed speak, they're clearly concerned on the inflation side and that they're not making enough progress on the labor side, and that inflation, they still have a long way to go. But I'm not sure that the noise that we've seen in the data in January justifies reacting to the February data, right? Like they've said that it's so noisy. We almost have to get to the March data to see what the real trend is and where we're going
So
here.
words are important. You used it twice, noise. Why do you think it is noisy?
Why is the data noisy?
Yeah, why is there not signal there?
You know, we have quickly shifted in the last 3 to 6 months from these concerns of a hard landing in the U.S. and really globally to synchronized growth globally. You had an earlier China reopening. Europe has had stronger data really coming out of Q4, both as a result of lower energy costs and then certainly a milder winter. And then you've had U.S. data accelerate, where people were talking about the end of the world is coming in Q2, right? Like,
Recession. The disinflationary process has started.
Yeah. So we've
more rate
shifted
hikes.
from this hard landing to no landing. And I think the idea of no landing is a bit optimistic, right? It's just a matter of where are we pushing out that landing to, and how strong is this recovery, and how long does it last? But I think it's very hard to look at the data and say with confidence we know where we're going. It's noisy.
Okay, so in this noise, I'd love to get you in the Chivarone versus Glisman divide, because we really saw this massive gap. You've got Chivarone saying last year was a year of duration risk, this year is a year of credit risk. Crispin Miller-Glisman coming out and saying that's the opposite, actually. Duration risk is still very much important because if you look at the data, it is supporting risk assets and it's supporting growth. Where do you stand on that?
Look, I think that duration, I think last year was like a very clear, you could look at the market and say, we can be short. I don't think that there's as obvious a duration trade, but I think duration risk is very clearly important. If they do step up to 50 in March, and then you have a very higher likelihood of 50 again in May, you're talking about another 100 basis points of hikes in the next 7 weeks, and the potential that I would assume if you step up to 50 and 50 that you're going to continue going, and you're talking about a terminal Fed rate that's much higher and another, right, we look at 2s at 5% and that's a high level, but if you are really stepping up, then are we talking about Fed funds at 6.5 or a much higher level than what the markets are talking? Then you bring duration risk, I think, much back into the picture.
At that point, I mean, where do you fall in terms of thinking that credit risk, to the Oksana Aronov's point or to the Steve Chivarone's point, really hasn't priced in this type of scenario versus, you know what, it'll hold in because a lot of companies have just termed out the maturities?
Look, I think that the struggle in credit is that when we look at corporate balance sheets still generally remain robust, and it's healthy for the medium term. And I think the problem becomes if you have a much larger step up in rates again, and where are these companies funding step up needs? And Tom, you bring up mortgage rates in the U.S., and I think that's critical. And like that's the most clear transmission mechanism in the U.S. But we also sit in the market in the U.S. that the majority of people have 30-year mortgages, right? Like you just don't move if you don't have to. Whereas we look globally, and I think other markets are much more constrained by the mortgage markets, Canada, the UK, Sweden. And can we then have a divergence in policy as a result of that, right?
Invesco lives a broad mandate every single day. I want you to focus, I don't know if you're up to speed on this, but the ginormous Johnson & Johnson spinoff, Clearview, Keeneview, whatever it is, K-View. It's like K-pop. It's whatever they're doing with Band-Aids and Aveeno and the rest of it. Yesterday, 8 parts, Lisa knows this better than me, it was 6 times oversubscribed. Describe the demand for people now to lock in 10, 20, 30-year yields.
From a corporation side?
Yeah.
Yeah, I mean, I think people still look at, right, like yields are materially higher than we have been for the last 5 years, 10 years. But on a historical basis, right, even when we talk about mortgages at 7%, that seems outrageously high to the last decade that we've seen, but it's not the 1980s levels that we've had, right? Like these are still there. That's a more normal level than saying like, oh, my 2.5% 30-year fixed mortgage that I'm just going to set and forget and not worry about, right? Like that's the world of the free money, the Teslas of free money of the world.
You teed up a trade. Just a little bit. You said there were opportunities in FX at the start of the conversation, and near the end of the conversation you talked about maybe differences in pass-through from rates into the mortgage market shaping up potentially some division within policy in the upcoming years. So is there an FX trade within that story off the back of real estate?
I think that there is. And again, I think that we're finally within DM central banks starting to see this potential divergence. So as you guys know, we're generally have an EM bias and have been constructive on EMFX. And I think the story remains the same there, and we remain constructive. And I think even EM central banks have done so much. Even if the Fed does more, I'm not sure that they have to chase it. Perhaps you'll price out some of the cuts there, but we remain constructive on EMFX. And then the question against it is, what DMFXs are you short against it, or how do you fund it? So I don't know that it's strictly a dollar story. I think when we zoom out and we say, are we at the start of a 10-year dollar cycle of dollar weaker? Yes, I think we have confidence of that. On a more short-term basis, yeah, it's a lot less compelling to own sterling, own CAD, own Aussie because of these housing market divergences and the pass-throughs.
Well, your framework screams short sterling. Just screams it. But I won't put words in your mouth. Christina Campmany of Invesco, even though I kind of did. But I'm not suggesting you get short sterling. I've got sterling savings too. Futures on the S&P. Not that that matters, of course.
But better
down
gifts
a third
for the
of 1%. I just thought, be transparent. Better gifts for the family if the dollar gets stronger.
Right,
absolutely. Totally. If the Campmany world comes around, Christmas is going to be great for everyone at home.
Everyone's like cheering quietly at home for like a weaker pound.
Futures negative. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Biden administration will unveil a new budget proposal today that officials say show a commitment to cutting the deficit. Sources tell Bloomberg it calls for a 25% minimum tax on billionaires, will nearly double the capital gains tax rate for investment, and will raise income levies on corporations and wealthy Americans. The plan has little chance of passing in Congress now that Republicans control the House. The UK plans to relax some data protection requirements under the European Union law. The bill includes reforms that would make it easier for British companies to mine user data for research and development. Businesses have cautiously welcomed the move. Privacy groups are critical. Bank of America has been one of the few major Wall Street banks to avoid mass job cuts. One reason is flexibility when it comes to dealing with staff. We spoke with CEO Brian Moynihan.
Or redeploy people across the franchise, including investment bankers, to other parts of the franchise to help us in the middle market investment banking. So you can move it. Our headcount peaked in January. It's down a few thousand. It can move, but you had to stop hiring, and that's what we had to do last fall.
Moynihan says B of A's attrition rate is now approaching an all-time low. The bank has more than 200,000 employees. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We're watching what's been happening in the crypto space, and what we see is quite a lot of turmoil. We see fraud, we see a lack of transparency, we see run risk, lots and lots of things like that. And so What we've been doing is making sure that the regulated financial institutions that we supervise and regulate are careful, are taking great care in the ways that they engage with the with the whole crypto space.
Chairman Powell of the Federal Reserve there on crypto. Silvergate Capital planning to wind down operations and liquidate its bank. A little bit more on that in just a moment. Your equity market shaping up as follows on the S&P 500. Futures negative 1/3%. Yields basically unchanged on a 10-year. There's your 4 handle on a 10-year maturity. Your yield 4% at the very front end. The 2-year just north of 5. Comes in a couple of basis points on a session, 5.05%. We are about 43 minutes away from jobless claims in America. And then 24 hours after that, it's all about payrolls, Tom. And then it's on to March 14th and CPI.
Yeah, that's the derby that we're in right now, and we'll keep you monitoring the rates that we see and what we see on the screen as well. John, I'm going to go back in the conversation we just had here. There's only one statistic that I guess is the thermometer right now, and that's the vanilla 210 spread, and it really hasn't moved all that much from the shock of 2 days ago.
Seeing it in negative triple digits, though. It's
minus 111, right? And we've barely pulled back. Minus 105 right now.
1981. Got to go back to 81 to something like this.
John, do you follow Bitcoin?
Not much.
It's grinding lower. I don't know what to make of it. 21,600. I don't. It's just this. Technically, it's a mess, and I don't know what to make of it.
As Chairman Powell mentioned, in the crypto space.
The crypto
space. Likes to call it.
Speaking of the crypto space, she's Bloomberg crypto space correspondent Shonali Bassick joining us right now. With an update. There was a point in, I believe, 1981 where a young Robert McTeer, who ended up running the Dallas Fed, and they had to look at 5 banks a weekend, 7 banks a weekend to shut down. So I know the headlines this morning is Bank A of the S names, but there's also a second bank, Signature Bank. It's New York State regulated. Do they make it to 4 p.m. this afternoon? Do they make it to Saturday?
There's no reason to believe that Signature doesn't. Remember, Signature, they are trading at a third of what they were trading at about a year ago, but they do have less exposure to crypto than Silvergate.
They're not a pure play on crypto.
Exactly. Silvergate, 90% of its deposits were tied to the crypto industry by September of last year. And remember, this ties in very closely to the broader banking industry because there's a lot of question around whether the reason they got into crypto in the first place was because it was so hard to be a regional and community bank in America at that time.
What is next? I don't understand. I mean, John, was it 8 cups of coffee ago that every young stud in Manhattan was a crypto bank expert? I think it was like, what,
basically,
9 months ago?
That was the thing. People were quitting their jobs to go and join this industry.
We're going to do crypto, do Christmas accounts, and give out Bitcoin. Is it dead?
It's not dead. Remember, Bitcoin itself
Why is it not dead? I'm not going to let you get off with that.
Right. So
why is it not dead?
If you think about it, we had a really great conversation recently for the crypto podcast with Jeremy Allaire. He is a person who runs Circle. No, well, think about it. He makes this great point that if you're paying via Venmo and you want to pay somebody in China, your Venmo account doesn't connect to their Grab account and you can't send them $100,000 via payment rails. So the payment rails in the country and globally are outdated. It is really hard to transfer money.
Use case makes a ton of sense.
Exactly. And USDC, stablecoins, that's the next part of this conversation. Stablecoins are backed by dollars, treasuries, and custodied in Bank of New York Mellon and managed in part by BlackRock.
Well, Jeremy Allaire is one of those who actually wants to see some of these banks fail or wants to see some of these crypto actors fail so that you can kind of weed out those actors, encourage some regulation around stable coins that are backed by assets that are audited, and get on with the use case scenario that we were just talking about. How much closer are we to that being a reality versus just simply the lowest hanging fruit getting washed out?
Lisa, to the extent that the regulators have entirely failed leading up to the collapse of FTX, stable coins would be the next place to start getting it together, because it is the most direct rail to the United States digital ecosystem when it pertains to the U.S. dollar. Remember, it's not like the United States Federal Reserve has their own central bank digital currency like China does. So stablecoins is really important. It's a huge on-ramp to the crypto ecosystem, but also a potential way to just pay for things digitally in a way that requires normal U.S. dollars, which is already, by the way, already happening.
So you get the sense that that is where the focus of regulation will be. We've been talking about this for months. How far does the contagion go? And it seems to have kind of lost some energy. People thinking, okay, well, there'll be a couple shoes, but otherwise things are kind of going to chug along as previously had been experienced. Is that true?
Well, think about it. Another firm is failing and nobody's really blinking an eye because people are getting so desensitized to firms failing, but billions of dollars are being lost in the meantime. Something else that's interesting is if you look at concerns from regional banks, once again, what they are concerned about is stablecoins. They're very worried that stablecoins will start to take up what more banks had previously done, which is why even community banks are pushing for stablecoin regulation because they're very worried about big tech getting into the industry.
This is ancient history. The Reserve Money Market Fund, and actually Federated, led on this 1 million years ago. Everything I read about stable coins believes the aim, the goal. There's no aim or goal. They want to be like a money market fund equivalent where we're always worried about breaking the buck. Do we have the audit process in place to study if stable coins are on a one-to-one basis, which with whatever the underlying is? I don't observe that.
And that's exactly right. If you look at some of the biggest stablecoin issuers, you just saw one essentially get pulled.
Then why are we talking about this? I don't understand where Gensler and the others are. And frankly, this is more a Fed-based issue, Lisa. I mean, this is not. This is serious stuff.
And that's the big question. Should they be regulated more like money market funds? Because that's what they look like.
I'm asking, what's the story?
I think one way to look at this, think about the way that some of these companies are using it. Coinbase, the reserve of USDC has been growing. And so, yes, they have $2 billion worth of cash, $2 billion worth of cash equivalents, essentially money market funds, and a growing amount of money in USDC. Will more firms decide to say, let's just hold USDC? It's held in BNY Mellon anyways, and then the Fed needs to start getting on it if that is the trajectory, so we don't have another Silvergate in the future.
Before we let you go, just to shift gears a little bit, it is not Silvergate, it is JP Morgan. The story, this headline coming out where they're basically going after and blaming the former executive Jess Staley for some of their association with Jeffrey Epstein and the sex crimes that he was accused of and convicted of. What is this all about? Why are they highlighting Jess Staley as a part of this?
You know what's really interesting about this entire Jeffrey Epstein saga is that the reason Jess Staley even was in trouble in the first place is because European regulators started to look at that. That process never happened in the United States with financial regulators, not with any financial firm that had any dealing with Jess Staley. And now you're seeing this issue play out in court as it pertains to JP Morgan, not among regulators, because of the role that Jeffrey Epstein had at JP Morgan when Jeffrey Epstein was a client.
Staley was pushed out of Barclays because of it. So what did Jamie Dimon say about it this week?
Yeah, I mean, the responsibility is being entirely pushed on to Jess Staley. And on top of that, they provided a little bit more information than you're seeing in existing court filings, which is that they are alleging that he had a closer tie to the young women that are alleging wrongdoing when it comes to both Jess Staley as well as Jeffrey
So they
Epstein.
want all of his pay back from his time there, is that right?
$80 million or so. A lot of money.
How does he respond? Does he say no?
Yeah, he's been fighting it. He's absolutely been saying that this is not accurate, right? And so this will, again, play out in courts and not among regulators. But for Jess Staley in particular, this is also playing out in international courts.
Shonali, thank you. Important story for us this morning on several fronts. Thank you very much. Shonali Basak there on the latest. Just to push forward for you, in the next 34 minutes or so, you get jobless claims in America. Then we'll push forward on to tomorrow when we get the payrolls report in the United States as well. Looking for something in and around 225. And the answer, the question that I keep getting on the Bloomberg from a lot of you this morning is just how low is the bar for that 50 basis point move from the Federal Reserve? Does 225 and 0.4% core CPI next week, month on month, get it done?
Lisa, I don't have any wisdom here.
What we've heard from people is, what is the greater liability? Disappointing and causing a more accommodative market, or going 50 and then be a flip-flopper that has to go back to 25 or raise another 50?
My answer is they're asymmetric, and the least risk is to stay 25. But that's, it's just blah, blah, blah.
I think the balance of risk shifted after Chairman Powell in the last couple of days. Futures right now down 0.2%. Andrew Sheets and Morgan Stanley coming up next.
Although economic indicators look fairly strong today, there is pain probably coming ahead. So this is a bit of a head fake market rally.
I think that we haven't really baked in that rates might be much higher than we've expected for a long period of time because we just had 10 years of zero rates.
That rise we've seen in inflation expectations and market-based measures, that's what's keeping me up at night. That is moving in the wrong direction.
The next time that the Fed cuts, we don't think it's going to be back to the zero lower bound.
The Fed's going to wind up pushing us into recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. In 30 minutes, you adjust and we adjust to get out 24 hours to the jobs day as well. John, I'm calling it 193,000 Thursday. That's the 4-week moving average of the claims number that we're waiting with bated breath for in 29 minutes.
Isn't that unbelievable historically? Just exceptionally low. We get that number in 29 minutes. The median estimate is 195. The previous number is 190. And as Tom pointed out, 24 hours away from payrolls in America. The median estimate right now is 225, the previous number. You're very familiar with that number, 517,000, which is just absolutely ridiculous. Andrew Hollenhorst of Citi published just moments ago. He said, we continue to expect a 50 basis point hike. Now, what's interesting about what Andrew suggested is it's 50 basis points with 225 on payrolls and 0.5% month-over-month core next week. That's how low he thinks the bar is.
It shows the uncertainty out there, and we got a whisper of this in Japan this morning, where not only real but nominal GDP adjusted for Kuroda's inflation induced was way off the mark. And I wonder what the way off the mark study is for tomorrow. I just really don't know.
I think the big what if. What if you get a massive revision to that? And then all of a sudden everyone's like, can I edit everything I've said in the last month?
Literally, we'll be talking about rate cuts. We'll be talking about rate cuts by September.
We have not heard this week from the crew looking for substantial disinflation down to 3%, or dare I say even lower. They're just sort of saying quiet, waiting in this data dependency.
We've had some great conversations in the last month, but one that stuck out for me was just James Athey of Aberdeen, who said this is table tennis narrative month to month. And I think we've said on this program as well, I've said it a few times, we've had 2 years worth of narratives in 2 months. And really the separating point, the dividing point was that February 3rd jobs report, Lisa, just a blowout.
My favorite part is that we're getting basically ping pong narratives daily now. We're basically shifting into something that's even more dramatic at a time when people can't agree what the bigger risk is. Is it inflation getting higher, or is it an economy crashing and causing everything to lose value?
And full disclosure, I am the worst table tennis player of the three of us. Lisa, I'm going to...
I actually am really good.
I'm going to... excuse me, would you like to chime in here?
I've got nothing to say about table tennis.
She's the one standing 10 feet.
The floor is yours.
She's like standing 10 feet away from the table, like the Chinese, going like this, killing it here.
You're pretty good.
I am.
What is that, like really good?
Like I can.
You beat the kids.
I beat the,
you beat the kids.
I beat the kids every
time. It's like you
time.
are really good at everything. It's
you
like
are
you
brutal.
Beat the kids.
All right, let's move on. What were you going to ask?
You're just so driven. But Lisa, to your wheelhouse, the
really
markets are ignoring this. Are we still on table tennis?
The markets are ignoring this. Carry on. All right.
Okay. The 3, 2, 1. The answer is the markets are ignoring this. Witness the J&J transaction yesterday. Witness where the move is versus the VIX. Life goes on.
Well, the markets are ignoring what? I guess this is the question, right? Because we heard from Christian Miller-Glissman that actually, if you buy the economy, perhaps we're less sensitive to interest rate hikes, and all of a sudden you could get a higher recovery and risk still looks good. And then you have the likes of Steve Chivrone coming out and saying he doesn't like bonds because the risks are that you're going to end up with inflation that gets a little bit too hot, and going forward, it's going to lead to a credit problem, not a duration problem. I find that divide interesting.
Well, the Treasury market's been listening all week, that's for sure. 5% on a 2-year. Big adjustment at the front end of the curve, Tom.
It is. I mean, the adjustments there, the spreads. I mean, 105 on the spread is where we were. 111 was the worst, I believe, John, yesterday. And you see it in every single data point. But again, I'm going to go out that life goes on. Let's dive into this right now. Andrew Sheets is really quite good at this. Chief cross asset strategist, I should say, at Morgan Stanley. Andrew, coalesce in the wonderful and fractious narratives, plural, at Morgan Stanley. What is your conviction right now?
Well, thanks. It's great to be here with you. So we still think that the U.S. economy is going to slow as we go throughout this year. And I do think the market might be a little bit too fixated on this kind of will they, won't they question of a recession, when the dominant force we think is still going to be a slowing in economy, both in real and nominal terms. Now, the recent data that we had out of payrolls and retail sales was very strong. I think that definitely worked against that narrative, but we'll see what the data comes this month. We'll see how that data looks without those large seasonal revisions in the same way. And we still see a lot of leading indicators pointing to a slowdown. So we still think that we should be positioned for decelerating growth, weaker than expected earnings, and we still think that that will be the dominant narrative when investors reach the midpoint of the year.
You're underweight global equities, Andrew, so let's start there. Is that spread equally between regions, or are there regions that you favour over others?
So I think the story in Asia is actually pretty notably different from the story we see elsewhere. So I think if you talk to investors and you ask them, why are you concerned about markets? The concern is decelerating growth, high inflation, hawkish monetary policy, high competing rates on cash, decelerating earnings growth, expensive valuations. That's not the story in Asia. That's not the story with Asian equities. These are markets that are generally pretty reasonably valued versus history. Growth is going to be improving. Inflation is not high. The central banks in Asia are not hawkish. And cash as a competing asset is actually quite low in yield. So I think that this is a story where overall we still see a lot of signs that suggest that this is a time to hold less equities than normal, to be underweight equities. But within that, we're much more optimistic about stocks in Asia, and we think there's a legitimately different macro story there that could help support that.
How can you justify, Andrew, being underweight equities, yet more positive, more constructive on credit?
So I do think that this is an environment where I think it's a little bit better suited to credit. And some of that is that I think in a decelerating growth environment, that is still tough for earnings. My colleague Mike Wilson and our equity strategy team, we are very worried about operating leverage, meaning that earnings really underperform what you see out of GDP. But that type of decline in earnings, we don't think really creates major credit problems, major refinancing problems for the bulk of the credit market. I also think that when we think about incentives, as yields move higher, think about this from a corporate treasurer perspective. All of a sudden, paying down your debt looks a lot more attractive than buying back your stock if the debt is yielding 5.5%, 6%. And so the idea that at higher yields, we might get more credit-friendly activity rather than shareholder-friendly activity is another part of our thinking.
Andrew, to combine these ideas of both the international approach and picking different regions within equities, and also your appreciation of credit and how it functions, how different is the picture for credit in different regions based on what Christina Campmany was talking about, which is that there are different regions with different sensitivities to rising rates, potentially more given variable rate interests?
So I do think that's a really great and important point. And I think across a lot of these different credit markets, you do see different outcomes. So a market like Europe is a market, especially European investment grade, is a market we like a lot. That's an investment grade market that yields 4.5% in euros. That's the same yield you got back in 2003 or 2004. And these companies have refinanced their debt to a pretty significant extent. It's some of the longest duration in that market that we've seen in its history. On the other hand, I think the leveraged loan market, where you have more issuers, where those debt costs are resetting quickly, there you have the feed through of costs that are much more significant. And my colleagues are also pretty cautious on the commercial real estate side. We still think that that is a market where you could really get hit from kind of both directions, that cap rates need to come up as risk-free rates have come up, but then also financing costs are up significantly. And so that's an area where we're more cautious, on the equity side. And I think that's still an area where we probably want to avoid relative to parts of the corporate credit market we like more.
Andrew, just to take this an extra question, I'm quite interested by this theme that you have, that ultimately the C-suite will make decisions that benefit credit investors more than equity investors. Is this another way of saying I want to bet on fallen angels becoming rising stars? Is that a story that you like within high yield credit?
Well, I do think that this is an environment where I think the incentives to be more conservative and be more cautious would seem to be there. I think if you combine CEO surveys, which are pretty notable, that much of the C-suite seems relatively downbeat about growth. That's, I think, gotten a little bit better in the most recent month, but still relatively downbeat. and then just the math of where bond yields are relative to equity and dividend yields, that I do think that this is an environment where we want to play for credit improvement more broadly. So in terms of the fallen angels specifically, I think that could be a little bit more complicated, because I think there you are often dealing with companies with a little bit more cyclicality, and there it might be harder to support that given our below consensus growth forecasts. But I think I do think it supports the idea of credit versus equities overall within a portfolio context.
Andrew, thank you for that. Smart stuff. Andrew Sheets of Morgan Stanley going into that data a little bit later with an interesting call there on credit, Lisa.
Yes.
You were asking the difference. Why do you like credit versus, say, equities right now? And there's the explanation.
I remember all of those years, I would look out at the prospectuses that would come out and they'd say, we're going to issue debt to buy back our shares. And I kept thinking, why are they putting up with this? And it's because there was no alternative, and really they had no other options. And now they're pushing back. And suddenly, it's looking a lot better to buy back those bonds. And all of a sudden, those shareholder-friendly activities go away, and it looks better from the credit perspective.
The leverage is not in the hands of the bond issuer anymore, so to speak, in the way it was.
Which is the reason why people like credit, even though there could be clouds on the horizon or tumultuous times ahead.
There are always clouds on the horizon, right?
They seem like they're greater right now with the inversion.
Aren't there always sort of clouds?
I can always find some, but I do think that, right now...
They're darker.
They are.
You ready for the reality here? Feeding frenzy on the J&J bonds. I loaded the boat, John, yesterday. I got a call last night. Fidelity didn't want to take it all, so they gave me some of it. And this is out 40 years, 5.2%. And I went in large at par, and I'm already down 66 days of interest because the price has come down just since Bramo's been talking it down. That's a movement.
That's Lisa's fault.
The price down on a 40-year piece this morning.
I think that Jay Powell has nothing to do with it. Just throwing that out there.
Not at all. This is all you.
It's the new bond world, after all. It's like the old days.
Must be logistics.
20 minutes away from jobless claims. Nita Richardson, just wonderful, from ADP, is going to join us shortly. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Israel, tens of thousands of people headed for protests over the government's plan to cut power of the Supreme Court. There may be demonstrations in 20 cities. Now, protesters are calling it a day of resistance to dictatorship. Prime Minister Benjamin Netanyahu and his allies say they're trying to rein in a court that has overstepped its authority. President Biden will target billionaires and rich investors in the budget request he unveils today. Billionaires would be hit with a 25% minimum tax. Income taxes on corporations and wealthy Americans would also be raised, and the capital gains tax rate for investments would be almost doubled to 39.6%. In Ukraine, Russia launched a devastating barrage against cities today. At least 5 people were killed. Hundreds of thousands more were plunged into blackouts. The Russians were said to use a new mix of weapons that mostly evaded air defenses. The only Goldman Sachs banker tried and convicted in the Global One MDB scandal sentenced today in New York. Roger Ung says he suffers from a substantial mental health condition and shouldn't receive the 15-year term that prosecutors want. The government says Ung was a key figure in the conspiracy to loot the Malaysian fund of billions of dollars. And General Electric expects profit margins at its aviation division to keep expanding over the long term as an independent business. GE Aerospace primarily makes and services jet engines. CEO Larry Culp said he expects to see revenue growth at a mid to high single-digit rate. GE is set to break up next year with aerospace, its remaining business. Global news powered by more than 27 journalists. I'm Lisa Mateo. This is Bloomberg.
If you want to solve inflation, according to their root book, you've got to keep on raising rates. And of course, don't forget there's a political element here. They don't want to damage the Biden administration by raising rates too much and killing the economy. They're going to continue at this path in being very careful about raising rates, but at the same time, once the election is over, then they'll go full gun.
It's quite an accusation.
Raise rates.
It's quite an accusation that Mark Mobius is making, the Mobius Capital Partners founding partner, basically saying that this Fed's not going as hard as it should do for political reasons.
I think a lot of people felt that that was the situation back in 2021 back in 2020. People think that perhaps there isn't the same kind of response to inflation that there should be. At the same time, we're not necessarily seeing unemployment go up or inflation come down. So you can make that argument. Yeah.
I know. He's dressed for summer. Very cool jacket, Mark Mobius. It's very warm in here. It's like summer now, isn't it?
He's a great guy. I did a magical thing with Mark Mobius. I did a
Tom's talking. Go on,
Tom.
What
are you talking about?
Nothing. She interrupted.
Okay.
Very rude.
Sorry, yeah. She's she's off
what
her
can you
game
do?
today. What can we do here? 15 minutes away from this important jobs report. I did a magical panel with Mr. Mobius years ago, Dr. Mobius, I should say, and his depth of knowledge of how EM has changed is stunning. Is the EM now the same as our stereotype of the EM from 20, 30 years ago? I'm not sure.
Even 10 years ago, I think we just called it a commodity story 10 years ago, Tom.
All you did
and
is
now if you look at the benchmark, it's full of tech companies.
In equity, you bought the mobile phone company and the concrete company, and that was the end of your research. And those days are gone. I mean, it's just evaporated. You see this, I mentioned this right now, is printing. Argentine peso, 200 pesos. That's the frontier economies falling apart. And yet, to Mr. Mobius's point, you've got to find the economies that will do well.
Argentina will love you calling them a frontier economy.
I think a lot of people would call that. Nigeria, Tunisia, and a few others there on the IMF radar. On our radar now in the White Marble of Capitol Hill is Henrietta Trey's Managing Director, partner, I should say, of Economic Research Veda Partners, always informative as well. I'm going to cut to the chase, Henrietta. The budget outlook at CBO is 19 Excel spreadsheet lines. The interest payment is modeled out at 6.8% of the budget, and it is jaw-dropping, their model of what we're going to pay in interest over the next 10 years. On a per-year basis, I thought it was a cumulative summation, and it's not. 10 years from now, we're going to pay $1.4 trillion in interest. Is it out of control?
I think everybody's going to make the case that it is out of control, but nobody's going to do anything to stop it. To put it in perspective, there's a $31.381 trillion debt ceiling, and we're talking about cutting $300 billion into the deficit. So it is definitely a humongous number. It will continue to rise, but there are no plans on the horizon to materially dent it. So get used to it.
Many others say calm down because the mathematics, the complex mathematics of this is wrapped around the growth rate of a nation versus the R-starred and the implied economics of the moment. Do we have the growthiness of America to get out 5 years, let alone 10 years?
I mean, I think you obviously have the growth right now. And another question is, how does it compare to the other nations that are coming out of the COVID still, that are in recession, dealing with bigger inflation than we are? A big question about it in sort of the morality circles of economic policies. How much does it matter? And what are we looking like compared to our peers, the rest of the globalized economy? So I think in general, the feeling is, and the voters are telling you, we love to rail about the deficit when it's convenient, but we don't have any bandwidth or the backbone to actually do anything about it. So you'll see that play out in the Social Security or the Medicare debate. You'll see that play out with Republicans calling to extend the 2017 tax cut, which alone was a $5 trillion bill, $1.5 trillion of which was pure deficit increases. So nobody's really willing to do anything about it, but they love to job on about it.
Which is a reason that maybe we're going to be talking more about TikTok than the debt ceiling debate coming into the election season, just because it's easier for people to wrap their heads around. I mean, is that basically how you can interpret some of the discussion and the unity that you see within parties that otherwise is lacking?
Absolutely. This is entirely about comparing and contrasting. And what's interesting about American politics right now is that almost everyone unanimously believes that China is a problem. So you'll see this president's budget come out later today with $885 billion just for defense. That's humongous for a Democrat or a Republican. And then on the other side, we have the issue of China. Obviously, you have all these defense folks coming out saying we need more capabilities on the defense side, but we need to continue to bolster Ukraine because it's a proxy war for what China would do to Taiwan. So there's just this tremendous focus on China from every direction, whether it's IP, defense spending, TikTok, AI. It's across the board. I think view the budget and the deficit conversation through the lens of China, and it helps everything make sense.
Henrietta, given the needs or the asks with respect to spending, and given the reluctance on all sides really to raise taxes ahead of an election season, and it's always ahead of an election season, what is the likelihood that we really have a problem here with respect to the debt ceiling debate that's different, that has a different character than the previous debt ceiling debates?
I was just talking to a dear former colleague, Pete Cohen, about this. I love that everybody says this time is different, this time it's a calamity, this time it's a train wreck, the House is a disaster. Exactly none of that is different from how it was in 2011, 2013, 2016. I mean, we have seen 2 consecutive Republican speakers' heads roll as a result of conflating the debt ceiling with the government funding bill and relying on Democrats to provide the bulk of the votes. And that's precisely what's going to happen here this year as well. So I find a lot more consistencies than differences, and the dysfunction is a normal part of especially the House of Representatives.
Henrietta Trace, one of the best, always great to get your thoughts. Henrietta Trace there,
level of
Vader
Washington
Partners.
cynicism is off the chart.
Let's be clear, though, and connect that Washington cynicism with how markets will at least take that point. The biggest risk is that people believe that it isn't different this time. And because people believe it isn't different this time, they'll ignore it, and they'll keep ignoring it. And guess what will happen as they ignore it? There will be no pressure on Washington, D.C. to come to any agreement. And that's why this is going to push right up to the edge.
My point is, like 2011, that operative mathematical word, suddenly. Everything's fine until suddenly it's not.
And when you start to believe it's different this time, that's when the market will move and they'll come to an agreement. Suddenly, to your point. Let's hope it doesn't go that far. But ultimately, that's the fear that some people have about how this might play out later this year.
I'm concerned that it is an incredibly difficult issue with a lot of tough choices to be made, and how much of the nuance gets lost in a discussion where you're talking points. I mean, really, we're talking about a massive budget, real issues, higher interest rates. These are all important discussions. And, you know, what are younger individuals in my household talking about? They're talking about TikTok and daylight savings and whether it's going to get kicked out. I mean, I'm just wondering whether that makes their job trickier, because there isn't as much room for nuance, especially heading into an election season.
I remember 10 years or so ago, do you remember when President Obama was going around saying the market should take it seriously? It's almost like they were willing the market to sell off and do something dramatic to push everyone to come together and come to an agreement. And right now that's not happening, and may not happen until much, much later in this summer, if at all.
My long-term moving average on claims coming off the great financial crisis, are you ready? 400,000 was normal coming off the crisis. Is a smooth moving average. It's shocking how far we are from any kind of normal on this number in 5 minutes.
Mike McKee's lurking in the shadows. Can you see him in a studio? Mike's turned up already.
I can't see that.
Mike's ready to go.
See over there.
5 minutes away from
Oh, he's
claims.
hidden by his entourage from where I'm looking.
195. Mike McKee's in the building. You know what that means. Some data's about to drop in about 5 minutes' time. 195 is the median estimate in our survey. 190 is the previous read. And then from there, the dance continues into payrolls tomorrow morning. 225 is the median estimate so far.
75 basis points.
In our survey. I'm not sure what it would take to get 75. Tell you what, you get a repeater last month and there'll be some talk of it. CPI still to come next week.
Why can't they take an eighth?
From New York City, this is Bloomberg.
3/8. From 2009, a glide path lower in claims, a more fully employed America, the pandemic getting in the way, changing that mathematics, and then the stunning shock of sub 200,000 fully employed American claims here week after week after week. It is not an embargoed statistic. With his first look at this anticipated statistic, Michael McKee.
Well, we are waiting for this first look. I guess a lot of people clicking on the internet at this time because the Labor Department drops it all at once for everybody. And here we go. 211,000. So Tom's week after week after week was just interrupted by a change in the direction and the amount for jobless claims. 211,000 is a pretty low number, but it is a significant change from the trend that we have been on, which was week after week after week of numbers coming in below estimates. I think 13 of the last 14 weeks we had jobless claims below the estimate. Well, the estimate was 195, so we're significantly above that at this point. Now we're looking to see if last week, I'm looking to see if last week was revised at all and revised higher, and I still don't have that number. There we go. No,
continuing claims, but we
continuing
don't have jobless claims.
We should mention this because this is also a change. Continuing claims going up 1,718,000 from 1,649,000. So we are seeing people taking longer, perhaps, to get jobs, and this is going to be the kind of trend that the Fed and everybody who has been predicting a slowdown in the labor markets is going to be looking at. Now, what we don't know, of course, is whether this is going to continue, but we are anticipating that it should. It was an increase. The 211, by the way, was an increase of 21,000. They did not revise.
They did not revise. Okay, that helps.
The prior week.
Let me do this. Let me do the markets right now, Michael, and I want to come back to you. And we see some real activity. We just see it with the green and the red blinking on the Bloomberg terminal. Futures somewhat catch a bid here, flat on the market right now. The 2-year yield 5.03%, indicating 4 basis points in. 10-year yield flat 3.98. 2-10 spread, Lisa, 111 basis points of massive inversion. We migrated back to 106 basis points, and we do a little better now with less inversion getting out in front of the story tomorrow.
It is so hard to game out because we're talking about not that many jobs, and we're talking about this question of just how low we're coming from in terms of a base. The fact that people are trading on this at all, though, highlights how uncertain we are at a moment where the Fed is watching this data so carefully.
I mean, I look, Mike, at the trend here in the 211. I'm going to say I'm doing this real quickly. I can't be like McKee folks. It gets me back to end of December 2022 off of the set of 6, 7, 8 data points is, well, can you figure out state by state where that jump came from 190-ish out to 210?
You can on a delayed basis is the problem is we don't get can
a big state or a little state jump it out of whack?
Well, no, because you're looking at total claims here, but you're going to be looking at states that have the largest working age population, unless there were a strike or something in a plant in a company. So the week of February 18th, the prior week, it was New Jersey and Rhode Island with 2,500. It looks like those were the highest uninsured employment rates. The largest increases in claims for the week ending February 25th, which was last week. Massachusetts up 4,000, Rhode Island up 1,200, and New Jersey up 742,000. So yeah, you get a reaction.
So you get a little bit of state granularity.
Interestingly enough, California was down 2,800, and Kentucky was down 6,164. Ohio down, Michigan down. So the biggest states were seeing declines.
Right.
Kind of hard to put this all in perspective, because you would expect if we were seeing a lot of tech jobs to go away, that California would be leading the pack, and they are not at this point, although we do still have that whole thing about getting severance pay and that keeping you out of the claims market.
In-N-Out Burger's been hiring. That's what this means right now. Equities lift here. We just showed it. For those of you on radio, the NASDAQ with a nice spike here, a little green on the screen, flat on the SPX. Dow up fractionally 38 points, a VIX 19.33. Speaking of granularity, and of course I went there with Michael McKee to stagger to our next guest, and she has the advantages of working for automatic data processing. Neela Richardson is chief economist for the people that punch out the payroll checks like nobody from sea to shining sea. Neela, at the ADP franchise, what do you see in your ADP granularity?
We see wages are strong. Look, ADP provides payroll services for over 25 million workers. That's about 20% of the working population. And we're tracking wages very carefully, especially as the economy is looking in the face of inflation. And what we're seeing is a little bit of a deceleration in pay growth, but still too high to be consistent with a 2% target. And that speaks to the tightness of the labor market. It's not maximum tightness right now. We've seen things come down. We've seen jobless claims go up. It's not at the maximum like it was in the summer and early fall of 2022, but it's still very, very tight compared to where we were before the pandemic, even though the unemployment rate is about the same.
How difficult, Neela, is it to talk about the labor market as a whole rather than the specific parts? And I say this because yesterday in the Beige Book, there was an anecdote about a construction company commissioning a plane to fly workers out to it because that was cheaper than trying, and actually more effective to get workers, not even cheaper, than trying to hire in the region. I mean, how much are you seeing strength that you've never seen before ongoing in specific industries?
It's a very fragmented market. To your point, Lisa, some parts of this economy are so interest rate sensitive, housing, construction, and yet some of those sectors are chronically undersupplied, housing, construction. And so you're seeing a real mix in the market right now. There are companies that overhired or maybe extended their hiring aggressively during the pandemic. You're seeing those same companies pull back. There are smaller companies that we track in our data that never got really a leg into this market because the labor market was so competitive and they had to compete for talent with larger firms. So it's really a mixed bag, but the common thread is that wage growth has been stronger than before the pandemic throughout the economy.
How bifurcated is it that wage growth among the lower income sectors has outpaced the higher income sectors pretty substantially? I mean, has that gap continued to widen as you see some of the layoffs in the tech sector and the white collar, the middle office workers that have gotten stripped out of certain areas, while you still see some of these service sectors continue to robustly hire?
Yeah, so we still see double-digit wage growth in leisure and hospitality sector and the ADP data. And that growth has come down. It's down a lot since, again, the summer of last year. But overall, the wage moderation has been really, really modest. In fact, there's only a couple sectors where wage growth now is lower than it was before the pandemic. Information tech is actually one of those sectors. So even though we're seeing layoffs, we're actually seeing information in the tech economy decelerate, the sharpest decline in wage growth of any other sector. That's notable.
The markets here recovering here. They were in negative, a lot of red on the screen, and we're back to a mixed red and green picture here. S&P futures at negative 1.50. I should point out that widely watched 2-10 spread, what the pros watch, is now at 105 basis points. Interesting to see if that breaks to less inversion. Neela Richardson, I just did a very informal long-term moving average study of claims out 8 minutes ago, and critically, the long-term moving average in March of 2020, the end of the pre-pandemic, is the same as it was right now. 219,000 is a close approximation of any arbitrary long-term moving average there. Are we back to pre-pandemic?
No. The economy has changed structurally. There's so many things that are different than they were in 2020. Just the advancement and adoption of hybrid work, for example. The fact that we're seeing double-digit wage gains in the lowest part of the pay scale, that's a complete change from the pandemic. During the pandemic, these low-wage workers were barely keeping up with then very low inflation. So we even saw declines year over year in pay growth for the lowest end of the spectrum. These workers have become much more competitive post-pandemic, as noted by the double-digit wage gain. So the wage structure has been turned around in the last 3 years. And the question is, will that endure through the next 3 years?
Neela, before we let you go, we're hearing from a little birdie named Michael McKee that the whisper number for tomorrow is currently 247,000. Do you think after 247 million, being created, I'm curious from your perspective, 247,000, what you believe will be the number based on the anecdotal information that you're seeing come out?
I think you're going to get a solid number. Let's start there. I think you're going to get strong job growth based on the private sector payroll data that we are seeing in ADP. We're not predicting the BLS. We're just looking at the market as we see it. And if you compare that with other data like jobless claims, like job openings, you're still seeing a robust gain. But I don't think you're going to get 500,000 jobs.
We should have you on every day. Neela Richardson, thank you so much. I can't say enough, folks, about the granularity of payroll analysis and automatic data processing. To be clear here now, legitimate green on the screen, futures up 3, Dow futures up 56, a VIX 19.33. We're even seeing the 2-year yield come in 6 basis points. So, people are digesting the data. And as you say, Lisa, brilliantly reclaiming towards the whisper number tomorrow.
Right. Do we end up having this feeling that perhaps it's not going to be as robust as we previously thought, that the Fed won't feel that much pressure to go 50 basis points at the March 22nd meeting? I don't know what the answer is. To me, the volatility on the backs of all of these numbers is instructive in and of itself. This feeling of how much the view of the market and the narrative hinges on specific numbers, the big one being tomorrow.
It's the parlor game of it. I get it. We've got the tools to do this, the Bloomberg and, all sorts of other data and stuff. But the answer is you just wait for the data, which we just did, and it pulled back a little bit.
I wonder how much people aren't really trading the cash instruments and they're just basically hedging
on
the margins.
A lot.
I feel like that's kind of what's happening more than actually going for the level.
There's been some good academic study about that, and there's a lot of just noise out there. A critical conversation on Ukraine, Russia, and Putin. William Browder of the Hermitage Capital Management will join us. This is Must Listen. We do that next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Biden administration will unveil a new budget proposal today that officials say show a commitment to cutting the deficit. Sources tell Bloomberg it calls for a 25% minimum tax on billionaires, will nearly double the capital gains tax rate for investment, and will raise income levies on corporations and wealthy Americans. The plan has little chance of passing Congress now that Republicans control the House. Senate Republican leader Mitch McConnell has been hospitalized after falling Wednesday night in Washington. An aide said McConnell tripped during a private dinner. No word on how badly he was hurt. McConnell is 81. He was elected to the Senate in 1984. Bank of America has been one of the few major Wall Street banks to avoid mass job cuts. One reason is flexibility when it comes to dealing with staff. We spoke with CEO Brian Moynihan.
Or redeploy people across the franchise, including investment bankers, to other parts of the franchise to help us in the middle market investment banking. So you can move it. Our headcount peaked in January. It's down a few thousand. It can move, but you had to stop hiring, and that's what we had to do last fall.
Moynihan says B of A's attrition rate is now approaching an all-time low. The bank has more than 200,000 employees. And Boeing will work with Shield AI to speed up the military's use of the startup's self-flying aircraft software. The two will also explore other defense applications for the artificial intelligence technology. Shield AI's HiveMind software has been deployed into combat planes and drones since 2018. Global news powered by more than 2,700 journalists. I'm Lisa Mateo. This is Bloomberg.
The IC continues to monitor Putin's reactions and his nuclear saber rattling. Our analysts assess that his current posturing is intended to deter the West from providing additional. The IC continues to monitor Putin's reactions and his nuclear saber rattling. Our analysts assess that his current posturing is intended to deter the West from providing additional support to Ukraine as he weighs a further escalation of the conflict. He probably will still remain confident that Russia can eventually militarily defeat Ukraine and wants to prevent Western support from tipping the balance and forcing a conflict with NATO.
Avril Haines, National Intelligence Director here, as we're all shocked by the reports that we see in the newspapers on Ukraine. A few days ago, I asked our great Lee Brody, can you figure out where Bill Browder is and can we get him on the show here? And this is really important. Here's an email, folks. I've never received an email like this. Bramo, I don't think you have either. Quote, I write to warn you about the assassination plot against you by the Russian security services and the foreseen future to happen. I did receive the fresh info on directly identifying you as a target for hit. That is the Bill Browder reality.
That is not my reality, I
will say. That is not our reality or many others as well.
Yeah, that is a culture that has been unearthed and has been behind in some ways what we've been witnessing over in the Eastern European region.
The book is Freezing Order, Bill Browder. I can't say enough about it with the clarity of 3, 4, and 5 years ago. Mr. Browder joins us this morning from London. Bill, I can go 8 ways here, particularly off of Angela Stent's work on Putin, my book of the year last year, but I can't. We've got a battle of Stalingrad going on right now in Ukraine. The Russians had to stop the Nazis, and they did with a wall of bodies. Translate that analog that Mr. Putin knows over to what we're witnessing in eastern Ukraine this evening.
Well, Putin basically doesn't care about the number of casualties. He has this huge military advantage that death of his soldiers doesn't even make him sleep worse at night. And so they're losing soldiers at a rate of 5 to 1 of the Ukrainians right now. They're throwing convicts, conscripts, and anyone else who they've been able to corral into this meat grinder. They're throwing them into battle and they're being mowed down. These people oftentimes don't have even the proper armor, guns or whatever, and they're being shot down on a major basis. And the purpose of this is to try to just soften up the Ukrainian lines. And no matter how good the Ukrainians are at fighting back, if wave after wave of soldiers are being thrown into this meat grinder at the Ukrainians, it has a negative impact. And that is going on right now as we speak. And it's, if you watch All Quiet on the Western Front, which is about World War I, right, this is the same type of tactics that are going on right now as we speak in Europe today.
An Oscar contender there. Bill Browder, when you were at Chicago, you and I were weaned on Thomas Schelling, the giant theorist on war and game theory. You've been courageous about saying, look, this is all about Putin. But what has changed in the last year? When Browder talks about Putin now, what's new?
Well, the main thing that's new is that Putin is showing himself to be totally not credible in all of his chest-thumping alpha male threats. He has a weak military. He didn't win in 3 days. He's running out of ammunition. His gas blackmail against Europe didn't work. They found alternatives. He thought that Europe wouldn't, in America and the Allies wouldn't react harshly. We have. He thought we wouldn't supply weapons. We have. And so he's completely, I would say, misjudged this war from start to finish. And as a result, Russia is not in a strong position. Russia is not going to win this war with the capacity and the capabilities they have right now, particularly if the West continues to provide weapons, which we're doing.
Which raises a question, how can we expedite the end, especially if it's basically a meat grinder at the front lines, which is tragic to watch on all counts. You used to be one of the largest foreign portfolio managers of Russian assets. I mean, how far we have come from that time. Financially, have we done everything possible to perhaps expedite an end to this tragedy?
Well, there's really 2 areas that we need to be continuing to help the Ukrainians on. The first, on the military side, is that they have asked for jets, which we have not provided. They've asked for long-range artillery, which we have not provided. And they've asked for a certain number of tanks, and we've only given them a fraction of what they've asked for. On the financial side, it's the one thing we can really do for them is to starve Putin of the financial resources to continue to fund this war. And we have done a lot on the financial side in terms of sanctions. But the one huge loophole in this whole system, and you could drive a truck through this loophole, is the sale of oil and gas from Russia to the west and to the east. Putin receives between $500 million and $1 billion a day, even after all these sanctions, after all the disconnection of Russia from the Western system. And that money is enough money to continue to fight this war into perpetuity. And so we have to figure out a way to stop him from getting that money, because as long as he gets that money, there's no stopping this war from his perspective.
It's deeply painful to read the articles, the very human articles about what's going on, the fighting, the victims of this fighting. Bill, I wonder how long it will take and whether this war can end with Vladimir Putin still the leader of Russia.
Well, there's two ways that this war could end. We could give the Ukrainians enough military weaponry so that they finally overcome Russia, which I think they have the capacity to do. Or the other thing that could happen, and this scares me a lot, is as the war drags on, and again, as I should point out, that Putin doesn't care about casualties, and so he can throw more and more men into the meat grinder, more and more casualties, and as it grinds on, the West can lose interest. And you're starting to hear noises in Washington, particularly out of the sort of far right of the Republican Party, the Marjorie Taylor Greene, Lauren Boebert, the Tucker Carlson, let's not finance Ukraine anymore. That's what they're saying. And if those fringe people start to become mainstream, America is the single most important backer of Ukraine right now. And if America were to step out, if there was a change in leadership in 2 years' time, Putin could win the war that way instead of winning on the battlefield. And so that, in my mind, is probably the scariest prospect that we're facing right now as far as Ukraine is concerned.
Bill Browder, can the dramatic exercise work now? The Ukrainians shocked with damage to a key bridge to Crimea a number of weeks ago. So many in the West seem to be looking for a dramatic moment to put Mr. Putin in his place. I'm guessing that's the thinking of children.
Well, not necessarily. Remember in the summer last year, completely unexpected for me and for anyone else who's been following this, the Ukrainians broke through the Russian lines and retook 54% of the territory that Russia had previously taken. It was dramatic. All the different places they pushed Russia back, and the Russians were running back, retreating. And it's not entirely impossible. And interestingly, where I get this little inkling that there's some chance of that happening is from the Russians themselves. This guy, Yevgeny Prigozhin, Putin's chef, the head of the Wagner group, this mercenary group.
Yeah.
He's out there screaming bloody murder, saying, if I don't get enough weaponry from the Russian government, we're going to collapse, and then everything will collapse. He's the one saying it. No one else is saying it. He's the one saying it. Now, it may be for internal political reasons, but if I hear him saying that, it makes me feel like, maybe there's a second chance for the Ukrainians to do the same thing that they did last summer. On the other hand, Putin has unlimited numbers of people he can throw at this, and he doesn't care whether they die.
Bill Browder, thank you so much for joining us with this update. With Hermitage Capital Management barely describes it. The book is Freezing Order. I will not mince words. It is chilling, to say the least. Lisa, it's intractable there, and I think the coverage of Maria Today on Anne-Marie Horton has just been so good on this. And frankly, the coverage, I find myself reading the New York Times, the battle reports, like from the lines. But what's chilling there is for Browder, who's really up to speed on this, alluding to this horrific modern movie, All Quiet on the Western Front, getting rave reviews for its brutality.
We thought this kind of warfare was over.
Exactly. Yes.
We thought we wouldn't see trench warfare. We thought we wouldn't see the levels of casualties that we hear and that we read reports of every single day. And yet here we are with a leader of a nation who does not care about casualties, as we were just hearing about.
We'll have to see. Bill Browder there, and we'll have much more from Maria Today on Anne-Marie Horton in the coming days. What we're going to do is stagger here forward into jobs report. After that claims report, pulling back a little bit more, employment angst. Equities catch up. Futures up 3, Dow futures up 53. In the yield space, okay, we'll go with it. A little less inversion this morning than the shock of the last 2 Powell days. Please stay with us. Tomorrow morning, beneath the headline numbers at 8:30, it will be Jobs Day. This is Bloomberg Surveillance.